Now I am just going to ask you two simple MCQs. Okay, on the screen. No need to write. It's so simple, no need to write. Or if you want, you can take a photo. Companies covered in phase 1 should have net worth. Option A, equal to 500 crore, equal and more than 500 crore, less than 500 crore, more than 250 but less than 500. So student who are learning at home will also reply. In the old course MCQ was not there, but in the new course they have said they will ask MCQ. So I am expecting the answer from student who are either attending online or on the YouTube. What is your answer? A or B or C or D? I have started getting answers. Let us see. B is the right answer. It should be equal to or more than 500 crore. So see how they will play with the words. You remember only 500 crore. Whether it is equal to or only more than, keep in mind. One more last question today and this chapter will be over. Ind AS will apply to. Answer please. Everybody. Ind AS will apply to both consolidated as well as standalone. Only consolidated, only standalone. Optional. Wow, optional. So what is your answer? Everybody. Student at home. Student on YouTube channel if you are watching. Okay. So the answer is, maybe there is a time lag, so I get the answer a little late. A is the right answer. Yes, you are right, Mr. Anup. Hello friends. Now we'll take MCQs on professional and ethical duty of chartered accountant. This is a new topic added in your syllabus and can be important for exam. This is mixture of auditing and financial reporting topic. Good chapter added in your syllabus which will give you a holistic view of a role of chartered accountant in financial reporting, which will have an impact on his professional ethics and conduct also. So here we will take our first question on professional and ethical duty of chartered accountant. You will participate. What should a chartered accountant do to comply with the principle of professional behavior? What should a chartered accountant do to comply with the principle of professional behavior? Option A, discredit the profession to raise awareness, follow relevant laws and regulation, promote personal interest over professional obligation, and engage in conduct that may compromise business relations. So the students are saying answer is B. Yes, the answer is B. You have to follow relevant laws and regulation. These three are not principles of professional behavior. The answer was B. Please tick mark option B. Second question, what is the primary responsibility of a chartered accountant in relation to pressure to breach the fundamental principle? Now, as a chartered accountant, you are going to come across a lot of pressure and you may be pressurized to breach the fundamental principle. What are you supposed to do? First option is succumb to the pressure if it comes from a superior. Option B, resist the pressure and report it to higher management. Option C, apply pressure on others, wow, to ensure compliance with the principles. And option D, evaluate the level of threat and take appropriate action. So the correct answer, as the students have pointed out, D is right. This is the best option. Evaluate first the level of threat and accordingly take appropriate action. Okay, this can also be the answer, but this is not the best of the answer. The best of the lot is the answer D. Answer D, tick mark. Question 3. Which principle emphasizes being straightforward and honest in professional and business relationship? Which principle emphasizes being straightforward and honest? Underline straightforward and honest. Integrity, objectivity, PCDC, and confidentiality. Which one highlights straightforward and honest? The answer is A, integrity. Very good answer. Answer was A. One more chance. Question number 4. What is the stance of the chartered accountant regarding conflict of interest? Conflict of interest are acceptable if managed properly. Point B, conflict of interest should be disclosed but can still compromise judgment. Option C, conflict of interest should not compromise business or professional judgment. And option D, conflict of interest are unavoidable and should be embraced. Which is the right answer? The students are saying, sir, C is the right option. You are right. Conflict of interest should not compromise professional or business judgment. Option C. One more question, number 5. Which principle is violated if a conflict of interest compromises professional or business judgment? Which principle is violated if a conflict of interest compromises business or professional judgment? So whether it is integrity, objectivity, professional competence and due care, or confidentiality. So when there is a conflict of interest, your objectivity is violated. You will not be able to take objective decision because there is a conflict of interest. So the correct answer is B. You are right. Now we'll take MCQ. Keep this book in front of you. Financial Reporting MCQ book. And you will find it towards the end. There is a chapter, Accounting and Technology. Can you locate that chapter? Accounting and Technology. We will take few MCQs, quite simple ones. Don't worry. This will give you an idea as to what kind of questions can be asked. So here is your first question. Which of the following statement best describes cloud computing? Which of the following statement best describes cloud computing? Option A is the use of physical server located in a company's premise to store and process data. B, the delivery of computing services over the internet, allowing access to data and software from any device with an internet connection. The process of using local storage device to store and manage data. And 4, the practice of relying on traditional client-server architecture for remote data access. So the correct answer is, everybody got it right, answer B, the delivery of computing services over the internet, allowing access to data and software from any device with an internet connection. So answer is B. Then second, which of the following best describes artificial intelligence? Which of the following best describes artificial intelligence? Option A, the simulation of human intelligence in machines, enabling them to perform tasks that would typically require human intervention. Option B, the process of programming computers to perform tasks without learning. Option C, the analysis of large amount of data to make prediction about future trend. And fourth is the automation of routine tasks in the accounting profession. If you think there are more than one correct answer, then you have to choose the best of the lot. So the best of the lot answer is A, the simulation of artificial intelligence. They are using the word intelligence, so you should choose this answer, simulation of human intelligence in machine. That is the best description of AI. These are other aspects relating to AI, but the best way to describe AI is simulation of human intelligence in machine. So please tick mark option A. Question number 3. Which of the following is not a benefit of automation process? Not a benefit. One is streamlined data entry, B, enhancing accuracy in accounting process, then C, increasing the risk of human error, and fourth, saving time and resources. So very simple answer, this is not a benefit of automation process. Automation does not increase the risk of human error, rather it reduces the risk of human error. So tick mark C. Now please come to question 4. What is the purpose of employee training in mitigating cyber security risk? Purpose of employee training in mitigating means reducing cyber security risk. Option A, to ensure that all the staff members are aware of the importance of cyber security. Option B, to make employees responsible for creating strong password. C, to limit access to sensitive data to a few select individual. And fourth, to eliminate the need of data backup. So here you are right, the answer is A, to ensure that all staff members are aware of the importance of cyber security and therefore employee training is required. Correct answer is A. Now one more, question number 5. Automation processes aid in compliance by introducing inaccuracy in accounting practice, generally generating financial statements that don't meet standard, C, streamlining data entry from source document, and D, increasing the risk of non-compliance and penalties only up to this, full stop, penalties. So the students have replied option C is the right answer. Streamlining data entry from source document, that is the benefit of automation. Other three are not the benefits of automation. So the answer was C. Now one more question I will take, question number 6. How do ERP system work? How do ERP system work? A, by using different data structure for each department to ensure data security. B, integrating multiple business systems from various vendors. And C, by providing real-time data to help managers compare performance across different locations. And D, by relying on manual data entry and validation process. What is the correct option? How do ERP works? The most relevant answer is C. The benefit of ERP is that the data is available to managers on real-time basis. Data is input from different sources, location, and you can access it on real-time basis and you can use it for decision making. So if you think more than one answers are okay, then you choose the best answer. Even option B is not completely wrong, but if you ask me which is the best answer, option C. Okay, so tick mark option C. So please come to, I have given at the end of this chapter 3 MCQs just to check whether you are awake or not. Ready? Quickly reply, then this standard will be over. Today don't sleep unless you revise all the questions given at the end. Okay? So read the question appearing on the screen and tell me which of the following report is not a component of financial statement as per Ind AS 1. Director report is not? Sure? Right. Okay, one more chance. Which of the following information is not specifically A disclosure requirement of Ind AS 1. You see the question, normally students will ignore disclosure requirement of a standard, and they are asking you which of them is not a disclosure requirement. You have to know what are the disclosure requirement, and out of that which is not specifically required. So be ready for such questions now. So you have to disclose the name of the reporting entity, yes. Other means of identification, any change, that is required. Name of the major significant shareholder. Did I tell you any time in the last 2 hours or 1 hour? No. So B, you keep it as side item. Level of rounding off you have to disclose, yes. Whether it is individual or consolidated statement, yes. So what is the answer which I am not supposed to disclose? Name of the major shareholder. If you disclose the name of major shareholder, your competitor will next day go and bargain with them. Is it right? So you can't give name of shareholder also. You can give some general information, but not the name of major shareholder. Then one last question. Which of the following is not required to be presented as a minimum information on the face of the balance sheet? On the face of the balance sheet is what is not required? Investment property is required. Investment accounted under equity method, biological asset. But contingent liability is never shown on the face. Where it is shown? Notes, below the balance sheet. So the answer is D. Hello, good evening everyone. Today we'll take some MCQs on Ind AS 8. So check how much you have understood Ind AS 8. Follow me. We'll solve some MCQs on Ind AS 8. So are you ready?
Yes, sir.
Question number 1. ABC Inc. changes its method of valuation of inventory from weighted average to first in first out method. XYZ should account for this change as. So there are 4 options in front of you. One is it is a change in the estimate and account for it prospectively. The other it is a change in accounting policy and account for it prospectively. C, option C, change in accounting policy and account for it retrospectively. And option D, it is account for it as a correction of an error and account for it retrospectively. So how many of you believe option A is the right answer? B, D, C. Vote for C. So let us ask computer, what is the right answer? Yes, option C is the right answer. Tick mark. Option C. Change in accounting policy, and it will be accounted retrospectively because it's a voluntary change. One more chance to check your understanding of Ind AS 8. Question number 2. Change in accounting policy does not include change in useful life from 10 years to 7 years. Does not include. Change in accounting policy does not include. Change in method of inventory from FIFO to weighted average. Then change in method of valuation of inventory from weighted average to FIFO. Change from the practice, that is convention. Accounting policy means practice and convention also, of paying as Christmas bonus 1 month salary to staff before the end of the year to the new practice of paying half month salary only. So which of these is not a change in accounting policy? A. Sure. Lock. Not B. B is an accounting policy. Very good. C is also change in accounting policy. D is also change in accounting policy. So if you have to choose the most appropriate answer, the answer will be A. Very good. So tick mark A. Then next question, number 3. When a company changes an accounting policy voluntarily, it has to inform shareholders prior to taking the decision, account for it retrospectively, treat the effect of change as an extraordinary item, and option D, treat it prospectively and adjust the effect of change in the current period and future period. B, not D. Treat it prospectively and adjust the effect of change in current and prior and future period. B, sure. It means you are understanding. It means you are understanding the standard. So the answer is account for it retrospectively because it's a voluntary change. Now question number 4 on your screen. When it is difficult to distinguish between a change in estimate and a change in accounting policy, everybody will reply, then an entity should treat the entire change as a change in estimate with appropriate disclosure. Option B, a portion on a reasonable basis, the relative amount of change in estimate and the change in accounting policy, and treat each one accordingly. Very good. Imagination. I can't even believe some people can imagine such thing. Treat the entire change as a change in accounting policy and treat this change is a mixture of two types of changes. It is best if it is ignored in the year of the change. The entity should then wait for the following year to see how the change develops and then treat it accordingly. So what according to you is the right answer? A. Everybody should reply louder. A. A is the right answer. Tick mark A. Yes, A was the right answer. One more question I will give you for your understanding. You have to learn the entire standard. Can you see? You are able to answer correctly because you have learnt it fully. When an independent valuation expert advises an entity that the salvage value of its plant and machinery had drastically changed and thus the change in material, what the entity should do? So they have to basically revise their depreciation. So let us see what are the options and what is the answer. Retrospectively change the depreciation charge based on the revised salvage value. Right or wrong? Wrong. Why? It is a change in estimate, so retrospective change is not required. Change the depreciation charge and treat it as a correction of error. It is not an error. Change the annual depreciation for the current year and future year. Yes. Ignore the effect of change on annual depreciation because change in salvage value would normally affect the future value only, since these are expected to be recovered in future. I don't know from where they draft such statement also. But then if you have studied, you will be able to answer correctly. Understood? So these were some examples of MCQs on Ind AS 8. You can be asked similar questions, so practice a lot. In order to answer MCQs, you have to study the chapter in detail. No shortcut. If you ignore certain thing, then some points can be asked in MCQ and you will not be able to answer. Like why it is wrong, that also you are aware. Why it is wrong, that also you should know, and why it is right, that also you should know. Okay, so these were some MCQ questions. The answer is C. So thank you very much for attending this MCQ session. Hello friends, now we are going to take MCQs on Ind AS 12. So are you willing to take this challenge of Ind AS 12 MCQs? So let us see how many of you can get these answers right. First come to Ind AS 12 MCQs. Question number 1. Ind AS 12 MCQ question number 1. Let us test your knowledge of Ind AS 12. Important question number 1. A subsidiary has sold goods costing $1.2 million to its parent for $1.4 million. All of the inventory is held by the parent at the year end. All the inventory is held by the parent at the year end. The subsidiary is 80% owned and the parent and subsidiary operate in different tax jurisdiction. The parent pays taxation at the rate 30% and the subsidiary pays taxation at the rate 30%. Calculate any deferred tax asset that arises on the sale of the inventory from the subsidiary to the parent. Now the student will have to answer what will be deferred tax asset. What will be deferred tax asset? And in consolidated financial statement, what would be the deferred tax asset? Show your skill on Ind AS 12. Show your skill on Ind AS 12. Okay, time over. Let us see how to do it. What is the unrealized profit? Unrealized profit is 0.2 million. 1.40 minus 1.2, 0.2 million, or you can say 2 lakhs multiplied by tax rate 30%. So the answer is $60,000. The answer would be $60,000. This 80% owned is not important. The unrealized profit on stock is 2 lakh. Deferred tax asset will be created on 2 lakh, that is coming to 60,000. So if you want to write the working note for this, maybe you can write, if you want, 2 lakh into 30%. 2 lakh into 30%, $60,000. Answer is A. Answer is A. Let us come to question number 2. Again test your skill. An entity issued a convertible bond on 1st January 2004 that matures in 5 years. The bond can be converted into ordinary share at any time. The entity has calculated that the liability and equity component of the bond are $3 million for the liability component and $1 million for the equity component. So this is a compound instrument and they have bifurcated the total proceeds into liability and equity component as 3 million and 1 million, giving a total amount of bond 4 million. Interest rate on the bond is 6% and the local tax legislation allows a tax deduction for the interest paid in cash. Calculate the deferred tax liability arising on the bond as at the year end, ending 31st December 2004. As at the year ending 31st December 2004, the local tax rate is 30%. The local tax rate is 30%. The local tax rate is 30%. So my question is, what will be deferred tax liability in this example based on the details provided to us? Deferred tax liability in this example based on details provided to us. Your carrying amount of the liability is 3. Carrying amount of the liability is 3. The tax base will be 4. tax base will be 4. Carrying amount of liability is less than tax base 4 because income tax law does not distinguish between equity component and the liability component. For them it is a debt instrument worth 4 million. So therefore there is a difference of 1, TTD, taxable temporary difference of 1 million into 30% tax rate, and the answer would be $3 lakh. If you want to write the working for this, you can. The answer is $3 lakh. Very good. Very good. Those who have answered correctly, good. You have understood this chapter. $3 lakh write down, and the brief calculation you can write is 1 million into 30%. 1 million into 30% is 3 lakh. Okay. Now we'll come to question number 3. An entity has revalued the property and has recognized the increase in the revaluation reserve in its financial statement. The carrying value of the property was 8 million and the revalued amount was $10 million. So my carrying amount has become 10 now, and the tax base was 6 million. So taxable temporary difference will be 4. Okay. Now it says in the country the tax rate applicable to the profit is 35% and the tax rate applicable to profit made on sale of property is 30%. Where will the tax liability be recognized and at what amount? Where will the tax liability be recognized and at what amount? Where will the tax liability be recognized and at what amount? Now we have two tax rate. Which rate we will take? We will assume that the objective is to sell the asset. If the objective is to sell the asset, we will apply 30%. But yes, this question can have one more answer. If the objective is to use the asset, we will apply 35%. Question is not fully clear on that front. So that comes to 1.2. And because it is because of revaluation, because it is due to revaluation, we are going to adjust in OCI. We are going to adjust in OCI. So only one answer is 1.20. Only one answer is 1.20. If I take 35%, the answer will be 1.40. But then it is saying it will be recognized in the statement of income and expense. Because the difference is due to revaluation, we have to take the deferred tax liability into OCI. So you write in bracket OCI and tick mark option B and write this calculation if you want. Okay. So 1.2, 10 minus 6 into 30%. One more question. The current liability of an entity includes fines and penalties for environmental damage. The fines and penalties are 10 million. The fines and penalties are not deductible for tax purpose. Fines and penalties are not deductible for tax purpose means they do not have future tax consequence. They do not have future tax consequence. And if an item does not have future tax consequence, what is the tax base? If an item does not have future tax consequence, what is the tax base? If an item does not have future tax consequence, the tax base is equal to carrying amount. So the answer is 10 million. So that there is no difference. So that there is no difference. If I take any other figure, difference will arise. And if difference will arise, I will have to create deferred tax. So to ensure no difference, keep the tax base also same. Okay, so the answer is A. The answer was A. Tick mark A, tax base will be same and therefore there is no difference. So these were some important questions on. Okay, now welcome to multiple choice question under Ind AS 16. Are you ready to take the challenge? Let us test your knowledge on Ind AS 16 property, plant and equipment. Questions are little advanced. Healthy Inc. quickly reply, okay, one by one. Brought a private jet for use of its top ranking official. Oh my God. The cost of the private jet is $15 million and can be depreciated either using a composite useful life or useful life of the major component. It is expected to be used over a period of 7 years. The engine of the jet has a useful life of 5 years. The private jet's tires are replaced every 2 years. The private jet will be depreciated using the straight line method over. Now there are 4 options. Option A, 7-year composite useful life. Option B, 5-year useful life for engine. 2-year useful life for tires. 7-year useful life for balance cost of jet. Option 3, 2-year useful life based on conservatism. Wow. And 5-year useful life based on simple average of the useful life of all major components. So what do you think is the answer? Option A. A is not right. Sure, B. Let us ask computer. Computer is also saying B. B is the right answer. You get 10,000 rupees. Question number 2. An entity imported machinery to install its new factory premises before year end. However, due to circumstances beyond its control, the machinery was delayed by a few months but reached the factory premises before year end. While this was happening, the entity learned from the bank that it was being charged interest on loan it had taken to fund the cost of the plant. What is the proper treatment of freight and interest expense under Ind AS 16? So this is my question. So you have following options. Both the expense should be capitalized. Interest may be capitalized, freight will be expense. Freight would be capitalized, interest cannot be capitalized, and both expenses should be expensed. Now first of all, whether freight is a directly attributable expense, whether interest is a borrowing cost under Ind AS 23, that is not very clear from the question, but it appears that this machinery is not a qualifying asset. It is in a ready to use state. If an asset is in a ready to use condition, it doesn't require significant amount of time for getting ready, then it is not a qualifying asset. And if it is not a qualifying asset, interest cannot be capitalized. So the answer will be choose that option where freight capitalization is given, interest not to be capitalized is given. So which is the option? Option C. C is the right answer. You get another 15,000 rupees. Okay. You give a wrong answer, everything I will deduct. Third option, XYZ Inc. owns a fleet of 200 cars and 20 ships. It operates in a capital intensive industry and thus has significant other PP that it carries in the book. It decided to revalue the PP. The company's accountant has suggested the alternatives that follow. Which of the following options XYZ should select in order to be in line with provision of Ind AS 16? It says revalue only 1/2 of each class of PP. Then second, revalue an entire class of PP. Third is revalue one ship at a time, as it is easier than revaluing all ships together. And fourth is, since assets are being revalued regularly, there is no need to depreciate. There are interesting options also. Which is the right answer?
D.
So if the student have read the standard in detail, he can easily catch the right answer. An entire class of PP will be revalued. You can't do selective revaluation. The right option was B. Okay, one more. Entity installed a new production facility and incurred a number of expenses at the point of installation. Is it right? The students who are learning from home, they will also reply. The entity's accountant is arguing that most expenses do not qualify for capitalization. Included in those expenses are initial operating losses. This should be. Now the question is the treatment of initial operating losses, which we have discussed in the first few lines only. It should be deferred and amortized. No. Expense and charge to income statement? Yes. Capitalized as a part of the cost of the plant as a directly attributable cost? No. And taken to retained earning? Wow! Students India's. Since it is unreasonable to present it as a part of the current year's income statement, what a great idea, but not acceptable. The correct answer is B. You are finding it easy because you have studied it just now. And every line item we have covered from the standard. But if you are studying it without studying, if you go, you will find it difficult. Fifth question, Ind AS 16 requires that revaluation surplus resulting from initial revaluation of PP should be treated in the following ways. Which of the four options mirror the requirement of Ind AS 16? Means which is the correct option? You are revaluing PP for the first time. Option A is to credit the retained earning. No, we can't credit retained earning. Release to the income statement an amount equal to difference between depreciation calculated on historical cost vis-a-vis revalued amount. You cannot release to income statement. It was under long back old Companies Act. Point C, deducted from current asset. My God. And added to the property, plant, equipment. This even I can't imagine also. Deducted from current asset and added to PP. Last option, let us check that also. Debited to the class of PP that is being revalued and credited to a reserve which is captioned as revaluation surplus, which is presented under equity. So which is the right answer? D or A? Sure D. Yes, D is the right answer. Hello and welcome to MCQs on Ind AS 19 employee benefits. One of the very important standards applied in practice. Let us see how much you are prepared for this standard. Test your understanding of Ind AS 19 with the help of few MCQs. An entity contributes to an industrial pension plan that provides a pension arrangement for its employees. A large number of other employers also contribute to the pension plan, and the entity makes contribution in respect of each employee. These contributions are kept separate from corporate assets and are used together with any investment income to purchase annuities for the retired employees. The only obligation of the entity is to pay the annual contribution. After this long story, this important line has appeared. The only obligation of the entity is to pay the annual contribution. The pension scheme is And this is also one hint, a large number of other employers also contribute to the pension plan. So it's a multi-employer plan because of the first line, and it is a defined contribution plan because of this line. Both together, please reply what is the right answer. Multi-employer plan and defined contribution scheme, multi-employer plan and defined benefit scheme, defined contribution plan only, defined benefit plan only. Yes, please reply first. So many students have replied A. Yes, your answer is right. Option A, tick mark. Question number 2. Which of these events will cause a change in the defined benefit obligation? Will cause a change in the DBO. Change in the mortality rates or the proportion of employees taking early retirement, change in estimated salaries or benefits that will accrue in the future, change in the estimated employee turnover, change in the discount rate used to calculate defined benefit liabilities and the value of the assets. And the last option is all of the above. Which is the correct answer? The student has replied E. Yes, you are right. All the above changes would cause a change in the defined benefit obligation. Let us ask computer, what is the right answer? E is the right answer. Very good. Let us try question number 3. An entity has decided to improve its defined benefit pension scheme. So this is a defined benefit scheme. The benefit payable will be determined by reference to 60 years of service rather than 80 years of service. As a result, the defined benefit pension liability will increase by 10 million. The average remaining service life of the employee is 10 years. How should the increase in the pension liability of $10 million be treated in the financial statement? One is the past service cost should be charged against retained profit. Past service cost should be charged against P&L account. Past service cost should be spread over the remaining working life of the employees. And the last option, very funny, past service cost should not be recognized only. So what do you think? What is the right answer? A, B, C or D? Most of the students have answered B. It should be recognized in profit and loss account. Right answer. Tick mark option B for question number 3. Which of these elements are taken into account when determining the discount rate to be used? When determining discount rate to be used, one is market yield at the balance sheet date on the government bond, then investment or actuarial risk, specific risk associated with entity's business, and risk that future experiences may differ from actuarial assumption. Discount rate is based on market yield on the government bond. Is it right? So the answer is right. A. Tick mark A. This all we have discussed in the classroom. Now the next is which of these assets should be included within the valuation of plan asset. Unpaid contribution, unlisted corporate bonds that are redeemable but not transferable without the entity's permission, a loan to the entity that cannot be assigned to a third party, and the last is investment in listed companies. Which of these assets should be included in the valuation of the plan asset? Usually this question is not asked in the exam, but what is the answer? The answer for this you tick mark. will be option D, valuation of listed security, because others are uncertain. This is unpaid contribution, forget it. Unlisted corporate bonds, but there is a restriction on the transferability, and similarly there is a restriction on this loan also. So the answer would be listed company shares or listed company investment. Tick mark option D. One more. Question number 6. An entity has decided to protect its pension obligation with an insurance policy. The insurance policy permits the entity to cash in the insurance policy. Is this insurance policy a qualifying insurance policy that will be included in the plan asset? Insurance policy permits the entity to cash in the insurance policy. Will it be included in the plan asset? The answer is no, because insurance company will make the payment. Answer is B. It is not included in plan asset. Okay, one last question. An entity operates a defined benefit pension plan and changes it on 1st January 2004 to defined contribution plan. A defined benefit plan changed to defined contribution plan. The defined benefit plan still relates to past service cost but not to future service. The net pension liability after the plan amendment is $70 million and the net pension liability before the amendment was $100 million. How should entity account for the change? How should the entity account for the change? This is easy. Before the change the liability was 100 million, after the change it is 70 million. So 30 million liability will reduce. 30 million liability will reduce. So the entity will recognize a gain of 30 million. Entity does not recognize a gain. Entity recognizes a gain of 30 million over the remaining service life. Entity recognizes the gain but applies the 10% corridor approach. This is old accounting. 10% corridor approach, not relevant anymore. We have not discussed that also. It is not applicable. It was old system. So the answer is A. Gain of 30 million will be recognized. Is it right? So these were few important MCQ question of Ind AS 19. Please subscribe. Please come to MCQ on Ind AS 20, accounting for government grant and disclosure of government assistance. Are you ready? Have you studied the standard? So let us check your intelligence. Those who have studied will reply. Okay, quickly. Question number 1. In case of non-monetary grant, which of the following accounting treatment is prescribed by Ind AS 20? Record the asset at replacement cost and the grant at nominal value. Oh, do we have anything like that? No. Record the grant at the value estimated by management. No. Record both the grant and the asset at fair value. Alternatively, measure these grants at nominal value. What do you think? Do we have this provision in the Ind AS 20? Yes, very good. And last also, record only the asset at fair value. Do not recognize the fair value of grant. So very clear answer. But if you have studied, you can answer. Otherwise, you will have your own option. So answer C, tick mark. Question number 2. In the case of grant related to asset GRA, which of this treatment balance sheet presentation is prescribed by Ind AS 20? Answer please. Record the grant at a nominal value in the first year. and write it off in subsequent year. Do we have anything like that? No, either set up the grant as deferred income or deduct it in arriving at the carrying amount of the asset. This seems to be right. Third, record the grant at fair value in the first year and take it to the income in the subsequent year. No. And take it to the income statement and disclose it as an extraordinary gain. That is the height of students' Ind AS. Is it right? So the answer was B, which means you are understanding. Try the next one. If you have given the correct answer, you are understanding. In the case of grant related to income, which of the accounting treatment is prescribed by Ind AS 20? This time I will not tell you. You read the option and you give me the answer. 5 seconds will be allowed to you. Your time starts now. You can do phone a friend also. Is the answer B? First one is totally wrong. Second one is right. Third is retained earning wrong. Fourth is sales or other revenue from operation. Oh my God. From where do they get such ideas? So the answer tick mark B. Very good. All the student in online mode also have given B as an answer. It means you are also attentive. Question number 4. Which of the disclosure is not required by Ind AS? Amazing question. Not required by, first of all, disclosure, which most of you ignore. And then they have given you not required, means out of 4 options, 3 are required. 1 is not required. You have to give me the answer. Accounting policy is required, unfulfilled conditions are required. Name of the government agency that gave the grant. Where is this? You can't give specific disclosures. Okay, this is wrong. Wrong option, means this is the answer. This is the answer. So we have to find the wrong disclosure mentioned here. And the last one is the nature and extent of grant recognized in financial statement and an indication of other form of government assistance. Very good. So odd man out is C. Is it right? Now one last option. Let us see who will give the right answer. Try yourself. Which of the following is not specifically excluded from the purview of Ind AS 20? So this question on scope paragraph, anything can be asked. Government participation in ownership, this is specifically excluded. Government grant covered by Ind AS 41, specifically excluded. Government assistance provided in the form of tax benefit, specifically excluded. Forgivable loan from the government, it is included in the Ind AS. Is it not included? We have taken question also on that. So the odd man out here is D. Just check, the answer is D. Yes. So these are the 5 MCQs which will give you an idea as to what kind of question can be tested. Okay. Dear students, please come to MCQ on Ind AS 21. Please come to MCQ on Ind AS 21. There are very interesting MCQs on Ind AS 21, effect of changes in foreign exchange rates. Let us see your preparation level for the exam. These are high quality MCQs. Check your level of preparation. Question number 1. Which of these consideration would not be relevant in determining the entity's functional currency? Which of them is not relevant in determining functional currency? Option A, currency that influences the cost of the entity, currency in which finance is generated, currency, all paragraphs are important. The currency in which receipts from operating activities are retained, and the next is the currency which is internationally acceptable for trading. This is not relevant consideration First three are important for determining functional currency. So the correct answer is option D, right answer. Very good. Question number 2. Foreign operations that are integral part of the operations of the entity would have the same functional currency as the entity. They are called extension of the reporting entity, right? Where a foreign operation functions independently from the parent. Foreign operation functions independently from the parent. They are not an extension. The functional currency of the foreign operation will be answer option A, that of the parent. B, determined using the guidance for determining an entity's functional currency. C, that of the country of incorporation. And D, the same as presentation currency. One student is saying same as presentation currency. The answer is wrong. The correct answer is B. If it is not extension of the reporting company, then the foreign operation will decide its own functional currency based on the same principle that is used to identify entities' functional currency. To say that functional currency of the subsidiary or foreign operation will be that of presentation currency is not right. Tick mark option B. Tick mark option B. Question number 3. An entity started trading in country A whose currency was dollar. After several years, the entity expanded and exported its product to country B whose currency was euro. The functional currency of the entity was deemed to be dollar by the end of 2007. But by the end of 2007, 80% of the business was conducted in country B using euro. So old functional currency dollar, new functional currency euro. At the end of 2006, 30% of the business was conducted in euro. Now 80% business is conducted in euro. What should be the functional currency now? What should be the functional currency now? Should it remain US dollar? Should it change to euro at the beginning of 2007? Should it change to euro at the end of 2007? Should it change to euro at the end of 2007 if it is considered that the underlying transaction, events and condition of business have changed? What is the right answer? Should it remain dollar or should we change it to euro if the underlying condition, transactions and events have changed? So the answer is D. Functional currency can change if the underlying event, transaction, condition have changed, and that has happened at the end of 2007. Tick mark option D. Now try your luck. Question number 4. See how much you have learned. An entity started trading in country A whose currency was the dollar. After several years, the entity expanded and exported the product to B whose currency was euro. The business was conducted through a subsidiary in country B. The subsidiary is essentially an extension of the entity's own business and the directors of the two entities are common. The functional currency of the subsidiary is the functional currency of the subsidiaries. The functional currency of the subsidiary, if it is an extension of the parent, will be same as the functional currency of the parent. And what is the functional currency of the parent? The functional currency of the parent is dollar. Functional currency of the parent is dollar. So what will be the functional currency of subsidiary if it is only an extension? The answer is A, dollar. it will have dollar as functional currency, as it is an extension of the parent company. Question number 5. An entity purchases plant from a foreign supplier for euro 3 million on 31st January 2006 when the exchange rate was euro 2 equal to $1. So you are going to purchase a plant account debit to supplier account. As on 31st March 2006 year ending date, the amount has not been paid. The closing exchange rate is euro 1.5 equal to $1. Entity's functional currency is dollar. Which of the following statement is correct? If the entity's functional currency is dollar, I have to convert euro 3 million into dollar on the date of acquisition when exchange rate is euro 2 equal to $1. So please tell me how much is the equivalent amount here. The equivalent amount is 1.5. Plant is a non-monetary item. It will not be revalued unless the company follows revaluation model, but supplier will be revalued. So closing rate is given 1.5. 3 divided by 1.5. Now the value of the closing creditor will be 2, recorded at 1.5. So exchange difference will come 0.5 to supplier of plant 0.5. These are the two entries I will pass. I have not read the answer. Now I will read the answer and see which is correct. Cost of the plant $2 million. Our answer is 1.5. So this option cannot be right. Cost of the plant is 1.5 million. This is right. Exchange loss is 0.6 million. This is wrong. Trade payable is $2 million. This is right. But this part is wrong. So this option can also not be right. Cost of the plant 1.5. Exchange loss 0.5. Trade payable 2. This option seems to be right. Next one is wrong because cost of plant is $2 million. So the correct answer is option C. First, mentally you should do this exercise and then check whether any option satisfies your answer. The answer C was right. Question number 6. An entity acquired all the share capital of a foreign entity at a consideration of euro 9 million on 30th June. The fair value of the net asset was euro 6 million and you have acquired 100%. No NCI. Goodwill will be 3 euro on the date of acquisition. The functional currency is dollar. The financial year ends on 31st December 2006. Exchange rate on June 30, 2006 and December 31st, 2006 was euro 1 equal to euro 1.5 equal to $1, euro 2 equal to $1 respectively. What figure for goodwill should be included in the financial statement for year ended 31st December 2006? We will use closing rate. Closing rate is euro 2 equal to $1. So euro 3 will be equal to 3 divided by 2, $1.5. Goodwill should appear at $1.5. Goodwill should appear at $1.5. Please check. Goodwill $1.5. Option C is right. Option C is right. You can note down this calculation if you want. This itself can be a 4-mark question in the exam if the option was not provided to you. It can be an independent 4-mark question for you in the exam. Okay, now we'll try. Question number 7. An entity has a subsidiary that operates in foreign country. The subsidiary sold goods to parent. Upstream transaction. Subsidiary to parent is called upstream transaction. The cost of the good to the subsidiary was euro 1.2 million. The goods were recorded by the entity at the subsidiary. This is the cost. What is the selling price? Selling price is 2.1 million euro. What is the profit? Profit is 0.9 million euro. Profit is 0.9 million euro. Next line. The goods were recorded by the entity at $1.05 million when the rate was $2 equal to 1. Is it right? So exchange rate on the date of transaction, euro 2 equal to $1. So unrealized profit will be 0.9 million euro divided by 2 to convert into dollar. You will get 0.45 million euro. 0.45 million euro is the answer, sorry, dollar is the answer. Multiplied by 10 lakh, you will get $4,50,000. In case of upstream transaction, do not look at the closing rate. Do not look at closing rate. Parent's inventory are not measured at closing rate. Therefore, closing rate given is not useful. That is given to confuse you. What is the value of the intra-group profit? That will be eliminated. The answer is 4,50,000. If any interested candidate wants to write the calculation, he can write it. He can write it. Is it right? But in your book also I have given you the calculation. You can check it from there also. So this completes our discussion on MCQ. The answer C was right. Hello friends, please come to MCQ on Ind AS 23. Ind AS 23 is borrowing cost. So we have some important MCQs for you. Please test your understanding of Ind AS 23. So my first question for you is, which of the following may not be considered a qualifying asset under Ind AS 23? Which is not a qualifying asset? I'll give you 4 options. You have to tell me which is the not a qualifying asset. First, a power generation plant that normally takes 2 years to construct, an expensive private jet that can be purchased from a local vendor, a toll bridge that usually takes more than 1 year to build, a ship that normally takes 1 to 2 years to complete. Which is not a qualifying asset in this option? Please try. Which is not a qualifying asset? Your answer is right. Option B, tick mark option B. Private jet which can be purchased from a local vendor is in a ready to use condition. It is not a qualifying asset. Now you try your luck. Question number 2. Which of the following cost may not be eligible for capitalization as borrowing cost under Ind AS 23? Which cost is not eligible? 1. Interest on bond issued to finance the construction of the qualifying asset. Amortization of discount or premium relating to borrowing that qualify for capitalization. 3rd, imputed cost of equity. 4th, exchange difference arising from foreign currency borrowing to the extent they are regarded as an adjustment to interest cost pertaining to a qualifying asset. Which is not a borrowing cost under Ind AS 23? Please try. Which is not a borrowing cost? which is not a borrowing cost? Very simple question. Out of these 4 options, which is not a borrowing cost under Ind AS 23? Ind AS 23 very clearly says imputed cost of equity is not a borrowing cost. So the correct answer was option C. Tick mark option C. Now we'll come to third MCQ. Capitalization of borrowing cost. Option A shall be suspended during temporary period of delay. B may be suspended only during extended period of delay in which active development is delayed. C should never be suspended once capitalization commences, and D shall be suspended only during extended period of delay in which active development is delayed. Which is the right answer? When will you suspend capitalization of borrowing cost? The standard is very clear. It says shall be suspended during extended period of delay in which active development is delayed. So tick mark option D. One more question is there in the booklet. I will read from your book one more question. Which of the following is not a disclosure requirement under Ind AS 23? Not a disclosure requirement under Ind AS 23. I am reading from the book. Accounting policy adopted for borrowing cost, amount of borrowing cost capitalized during the period, segregation of assets that are qualifying asset from asset on the balance sheet, or a disclosure in the footnote to the financial statement, and D capitalization rate used to determine the amount of borrowing cost eligible for the period. So you tick mark option C. There is no requirement of segregation of asset that are qualifying asset from other asset in the balance sheet. So that option is the right answer. Accounting policy is to be disclosed, borrowing cost capitalized is to be disclosed, capitalization rate used is to be disclosed. Is it right? So this wonderful chapter. Hello and welcome to Ind AS 28 MCQs. Test your knowledge of Ind AS 28 by answering these MCQs. So you will know how much you are prepared. First question on Ind AS 28. An entity has bought a 25% share in another entity with a view to selling that investment within 6 months. So investment is acquired with an intention to sell. The investment has been classified as held for sale in accordance with Ind AS 105. How should the investment be treated in the final year accounts? How should investment be treated? So first answer option A is it should be equity accounted. True or false? If it is held for sale, the assets and liabilities should be presented separately from other assets in the balance sheet under Ind AS 105. Pooling of interest method of accounting should be used. Oh my God. Purchase accounting should be used. Equity method, purchase method, pooling of interest method, or Ind AS 105. Ind AS 105 will become applicable if the investment is held for sale and it will be shown separately as current asset item held for sale investment. Answer B, tick mark. Okay, let us see who will get the second answer right. How is goodwill arising on acquisition of an associate dealt within the financial statement? Please reply. Is it amortized? Is it impairment tested individually? No. Is it written off against P&L account? Goodwill is not recognized separately. it is remaining within the carrying amount of the investment. So the option is D. Correct option is D. Only those who have studied will be able to answer quickly. Okay, try this one. What should happen when the financial statement of an associate are not prepared to the same date as on the investor's account? First of all, the financial statement of the parent and associate should be of the same date. Maximum difference allowed was how much? 3 months. And then you have to make adjustment for significant event and transaction. Search for that option. The answer D. If the associate or joint venture reporting date is different from investor, adjustment for significant event and transaction between these two dates shall be made. In any case, the difference shall not exceed 3 months. So this is the provision of Ind AS 28 when associate has a different reporting period. So very clearly the answer is D. There is no need to read the other options also. Option D. Okay, try this fourth question. If the investor ceases to have significant influence over an associate, how should the investment be treated? It will still be treated as equity accounting? No, it will be treated as per Ind AS 109 fair value method. The investment should be frozen at the date at which the investor ceases to have significant influence. The investment should be treated at cost. So the answer is you have to apply Ind AS 109 fair value accounting from that date. One more question for you, a numerical question. Let us see who will answer it correctly. Are you ready? Answer. An investor sells inventory for cash to 25% associate. So this is called downstream transaction. The inventory cost the investor $6 million and is sold to the associate for $10 million. So how much was the profit made? 4 million. None of the inventory has been sold at the year end. How much of the profit on transaction would be reported in the group account? How much profit will be recognized and how much will be unrecognized? Total profit is 4 million minus 25%, your stake will not be recognized. This will be unrealized profit, but remaining 3 will be treated as realized. Treated as if you are selling 75% of inventory to outsiders and 25% to yourself. With respect to the inventory sold to yourself, profit is not realized till it is sold by the associate to a third party. But 75% of the profit can be recognized. So the answer is 3 million. Do we have any option of 3 million? Yes. Some of you are thinking 1 million. But that is 1 million is unrealized profit. Then tick mark 1. Realized profit will be 3. Okay. So the answer is option C. So dear student, welcome to MCQ on Ind AS 32. And please, you will also participate. Check how much you have understood. The set of MCQs will complete your quick revision of this chapter Ind AS 32 financial instrument presentation. So here is my question number 1. Please answer. Question number 1. Are there any circumstances when a contract that is not a financial instrument would be accounted for as a financial instrument under Ind AS 32 and Ind AS 109? A contract for non-financial instrument, can it be covered by Ind AS 32 or Ind AS 109? So read the option and tell me what is the answer. First, option A says only financial instruments are accounted for as financial instrument. This is not correct. Yes, gold, silver and other precious metal that are readily convertible to cash are accounted as financial instrument. This is not correct. Point C says yes, a contract for future purchase or delivery of commodity or other non-financial item like gold, silver, electricity, gas generally is accounted for as a financial instrument if the contract can be settled net. This seems to be the right answer. And point number D says that yes, an entity may designate any non-financial asset that may be readily convertible to cash or a financial instrument. There is no such scope in this standard, that is students Ind AS. So some students, Ajit, have given right answer, Minal right answer. Okay, everybody should reply. Tick mark C. Very good question. Now we'll go to question number 2. Which of the following is not a financial asset? Come on, try. Not a financial asset. Not a financial asset. Cash is a financial asset. Equity instrument is a financial asset. A contract that may or will be settled in entity's own equity instrument. And the last one, prepaid expense. Is prepaid expense a financial asset? Prepaid expense, is a prepaid expense a financial asset? This can be a financial asset. Contract that will or may be settled in entity's own equity instrument. Okay, this can be a financial asset. Prepaid expense is not a financial asset because it is not a contractual right to receive cash or other financial asset. It's a contractual right to receive service or other asset, not cash or other financial asset. So the answer was T. Prepaid expenses are not financial asset. Okay, now the student will try question number 3. Which of the following liabilities is a financial liability? And keep a count on how many answers you have got right. Keep a count. Later on we'll see who got maximum marks. Which of the following liability is a financial liability? Deferred revenue, warranty obligation, constructive obligation. Point number D, an obligation to deliver. In your book there is a small typing mistake. Contract to deliver variable number of own shares worth a fixed amount of cash. So which do you think is the financial liability? All of you have answered D, that is correct. Answer D, contract to deliver variable number of own equity share. Very good, Veema Reddy. Keep trying. Question number 4, another good question. Which of the following statements best describes the principle for classifying an issued financial instrument as either a financial liability or equity? Think and answer. I'll wait for you. I'm waiting for your answer. All the students are saying option A is right. Instrument should be classified as equity or liability in accordance with the substance of the contractual arrangement. Seems to be right, so I will keep it on hold. Issued instruments are classified as liability or equity as per legal form. No, we don't have to look at legal form. Instruments are classified as liability or equity in accordance with management's designation. This is students' way of Ind AS. Okay. Issued instruments are classified as liability or equity in accordance with the risk and reward of the contractual arrangement. This is totally imaginary statement. So the answer was A. A is the right answer. Tick mark A. Keep the score with you. Question number 5. Which of the following instrument would not be classified as financial liability? Would not be classified as financial liability. You will read it and then we'll check. Which of them is not financial liability? Many students have replied C. C is the right answer because a return call option that gives the holder the right to purchase a fixed number of share against a fixed price. If fixed for fixed test is passed, it is an equity instrument. In other three cases, it is a financial liability. There is an obligation to pay cash here, and there is an obligation to issue variable number of own share. A, B and D are financial liabilities. C is an equity instrument. So tick mark option C. Question number 6. What is the principle of accounting for a compound instrument? So you will read the options and you will try. Then I will explain. What is the principle of accounting for a compound instrument? All the students are saying B. B is the right answer. The issuer shall classify the liability and equity component of a compound instrument separately as financial liability and equity instrument. Why others are wrong? Let us see. The issuer shall classify a compound instrument as either a liability or equity. Either as a liability or equity. There is no such choice based on an evaluation of the predominant characteristics of the contractual arrangement. This is wrong. The issuer shall classify a compound instrument as a liability in its entirety until converted into equity, unless the equity instrument is detachable and separately transferable, in which case the liability and equity will be presented separately. No, there is no such condition of detachability and separately transferable. This is imagination only. The issuer shall classify a compound instrument as a liability in its entirety unless converted into equity. This is your intermediate classification. Final classification is you have to bifurcate into the liability and the equity portion. Question number 7. First read the question and solve yourself. Then we will discuss why some answer is right and why some answer is wrong. Yes, please. The answer given by all the students is A. Let me check. How are the proceeds from issuing a compound instrument allocated in the liability and equity component? First, you have to calculate the liability at fair value. Remainder amount will be allocated to equity. Seems to be right. I'll hold it, but we have to read other options also. First, the equity component is measured at fair value. Wrong. I will not read further. First, equity cannot be measured. First, you have to measure liability. First, the fair value of both equity and liability are estimated and then allocated in the ratio of fair value. Wrong. You don't have to allocate in the ratio of fair value. You have to first value liability. Equity is the residual component. And point D, the equity component is measured at intrinsic value. Wrong. There is no such concept as intrinsic value in this standard only. Answer A was right. One more question. Please participate and see whether you have understood Ind AS 32. What are the conditions for offsetting or net presentation of financial asset and financial liability? When we can set off financial asset and financial liability? First, it says there is a legal right to set off. This is partially correct. legal right to set off and an intention to settle net or simultaneously. This is right. So many students have given this answer as right. B, the existence of a clearing mechanism or other market mechanism for net settlement and an expectation of net settlement. I don't know from where they have got this idea of clearing mechanism or market mechanism. Ram has to pay to Shyam, Shyam has to pay to Ram. Why we need a clearing mechanism? Students Ind AS. A netting agreement and an expectation of net settlement. Okay, we don't require a netting agreement. There must be intention to settle net and legal right to set off. So option B is right. Option B was right. Check the answer. Option B is right. Dear student, now we are going to take MCQs on Ind AS 33, earnings per share. So please participate and check how much you are prepared for Ind AS 33 MCQs. So here we begin with our first question. Earnings per share is calculated before accounting for which of the following items? Please reply. Earning per share is calculated before accounting for which of the following items? Earning per share is calculated before accounting for which of the following items? Is it before deducting preference dividend, ordinary dividend, taxation, or minority interest? So the answer is B, ordinary dividend. We do not deduct ordinary dividend while calculating profit attributable to shareholders of parent entity. So tick mark B. Other options are not right. Then second question, is it right? When an enterprise makes a bonus issue, stock split or reverse stock split or a right issue, then option A, previous year EPS is not adjusted, previous year's EPS is adjusted, only a note of the effect of the previous year EPS is made and only the diluted EPS for the previous year is adjusted. Many students have replied option B is the right answer. The previous year basic and diluted EPS both will be adjusted. Tick mark option B. Third question, if a stock option is converted on 31st March 20x1, if a stock option is converted on 31st March 20x1, then option A, potential ordinary share, that is stock option, are included in the diluted EPS up to 31st March 20x1 and then in the basic EPS from the date converted to the year end, both weighted accordingly. Now option B, the ordinary shares are not included in the diluted EPS calculation but are included in basic EPS. Option C, the ordinary shares are not included in the basic EPS but are included in the diluted EPS. Which is the right answer? The answer A is the right answer. Up to 31st March 20x1, it will be included in diluted EPS and thereafter it will be included in the basic EPS. Option A is right. Very good. Question 4. In calculating whether potential ordinary shares are dilutive, the profit figure used as the control number is option A, net profit after taxation including discontinued operation. Option B, net profit from continuing operation. Option C, net profit before tax including discontinued operation. Option D, retained profit for the year after dividend. There can be only one answer to this question. Anybody? Many students have replied option B. You are right. Net profit from continued operation is the control figure to identify whether a potential ordinary share is dilutive or Anti-dilutive. You are right. Question number 5. True false question. Potential ordinary shares issued by a subsidiary should be included in the diluted EPS calculation, as they could potentially have an impact on the net profit for the period, and the number of shares to be included in the calculation. Is the statement true or false? Is the statement true or false? Potential ordinary shares should issued by a subsidiary is included in the diluted EPS calculation. The answer is true. We have solved few questions in the class where subsidiary had issued potential ordinary shares. The statement is true. Now come to 6th question. An enterprise need disclose diluted EPS only if it differs from basic EPS by a material amount. This is totally false. Even if they are not different, you have to disclose diluted EPS. The statement was false. Next question number 7. If a bonus issue occurs between the year end and the date the financial statements are authorized, bonus is issued after the year end but before the financial statements are authorized, then EPS for both the current year and previous year are adjusted. EPS for only current year is adjusted, no adjustment is made, and diluted EPS is adjusted only. Which is the right answer? Which is the right answer? Option A is the right answer. Even if bonus issue is made after the year end but before the financial statements are authorized, you will give the effect of bonus issue in the current year as well as the previous year presented for comparison purpose. The correct answer is A. Question number 8. If a new issue of share for cash is made between the year end, this is for cash, this is not bonus share, and then the financial between the date of year end and the date when financial statements are authorized, then option A, EPS for the current and previous year are adjusted. EPS for current year only is adjusted, no adjustment is made to the EPS. And D, diluted EPS only is adjusted. What is the answer? The answer is no adjustment is made to the EPS. Only disclosure is made in the notes. Only disclosure is required in the notes. So the answer is C. But if it was a bonus issue or stock split or reverse stock split, we would have made the adjustment. Question number 9. The weighted average number of shares outstanding during the period for all periods other than the conversion of potential ordinary shares shall be adjusted for A, any change in the number of ordinary shares without change in resource, any prior period adjustment, any new issue of share for cash, any convertible instrument settled in cash. What is the right answer? The right answer is A. So whenever there is any change in the number of ordinary share without a change in resource, the current all previous period will be adjusted. All previous period would be adjusted. And then the second option is any prior year adjustment. The answer cannot be true here because any means it may not affect the profit. It can be any other prior period adjustment which may not have any effect on the profit. Therefore, answer B is not right. Now one more, question number 10. Question number 10, when ordinary shares are issued but not fully paid, then the ordinary shares are treated in the calculation of basic EPS. Option A, in the same way as fully paid ordinary share. Option B, as a fraction of an ordinary share to the extent that they are entitled to participate in dividend. Option C, in the same way as warrants or options and are included only in diluted EPS. Option D, very interesting, are ignored for the purpose of basic and diluted EPS. So there is only one right answer and you have given the correct answer, B, as a fraction of an ordinary share to the extent they are entitled to participate in the dividend. So B was the right answer. Now we are going to take multiple choice question on Ind AS 34, interim financial reporting. So let us check your understanding and knowledge of Ind AS 34, starting with question number 1. Please participate in the discussion and see whether you have prepared for Ind AS 34 or not. Question number 1 is Ind AS 34, interim financial reports should be published. Option A, once a year at any time in that year within a month of the half year end on a quarterly basis. Option D, whenever the entity wishes. I'll give you 5 seconds to try. Most of the students are saying option D. Option D is the right answer because Ind AS 34 does not make it mandatory. Ind AS 34 does not make it mandatory as to when, with what frequency you should prepare interim financial report. It is left to the management. It is left to the entity, and the entity may prepare interim financial report which can be monthly, quarterly, half yearly, or they may not prepare also. They can prepare if required by the law, but Ind AS 34 does not make it compulsory to prepare interim financial report. Question number 2. If an entity does not prepare interim financial report, suppose you don't prepare interim financial report, then the year-end financial statements are deemed not to comply with Ind AS. Option B, the year-end financial statements compliance with Ind AS is not affected. Option C, the year-end financial statement will not be acceptable under local legislation. Option D, interim financial report should be included in the year-end financial statement. So which of the options is correct? All the students are saying option B is correct. You are right. So it does not affect your compliance with Ind AS because you have not prepared interim financial report. It is not mandatory. Under Ind AS it is not mandatory. So if you don't prepare interim financial report, your financial statements are still Ind AS compliant at the end of the year. Now we will test your one more knowledge. Question number 3, interim financial report should include as a minimum a complete set of financial statement complying with Ind AS 1. Option B, a condensed set of financial statement and selected notes, a balance sheet and income statement only. Option D, a condensed balance sheet, income statement and cash flow statement only. Which option is right? All the students are saying option B. I also agree. Option B is right. A condensed set of financial statement and selected notes. So tick mark option B is the right answer. So now we'll move to question number 4. Ind AS 34 states a presumption that anyone reading interim financial report will, option A, understand all IFRS. That means person reading interim report, it is assumed that he knows IFRS. He have access to the records of the entity, amazing, have access to the most recent annual report and not make decisions based on the report. So which option is right? Person reading interim financial report, it is assumed that he has access to the most recent annual report. You are right. Answer was option C. Fourth answer is C. Please tick mark C. Question number 5. An entity owns a number of farms and harvests produce seasonally. So this is a seasonal business. Approximately 80% of the entity sales are in the period August to October. Seasonal business. 80% of revenue comes from the 4 months, August, September, October, 3 months. Because the entity's business is seasonal, Ind AS 34 suggests. So what is the suggestion of Ind AS 34? Additional notes be written in the interim reports about the seasonal nature of the business, disclosure of the financial information for the latest and comparative 12 months period in addition to the interim report. Option C, additional disclosure in the accounting policy note. And fourth is no additional disclosure. So this question will have two answers. One is you have to give additional financial information for latest and comparative 12 months period, so that one full cycle is complete, and you have to also give information about seasonal nature of the business. You have to also give information about seasonal nature of the business, so that the users are not confused because of the fluctuating profit. So you can tick mark B and A, but in the exam the first preference will be given to B. If both options are there, then you have to tick mark B. Now we'll go to question number 6. Very good question for testing your knowledge on Ind AS 34. An entity operates in the travel industry and incurs cost unevenly throughout the financial year. Advertisement cost of $2 million were incurred on March 1, 2007. So this is advertisement cost, 2 million incurred on March, and staff bonuses were paid at year end based on sales. So two types of expenses are there. One is advertisement, second is staff bonus. Staff bonus are expected to be around 20 million for the year. Of that sum, $3 million relates to period ending 31st March 2007. So out of total annual bonus 20 million, 3 million relates to first quarter. What cost should be included in the entity's quarterly financial report to March 31, 2007? So what are the expenses you are going to record in first quarter? Option A, advertisement cost $2 million and staff bonus $5 million. Option B, advertisement cost $0.5 million, staff bonus $5 million. Option C, advertisement cost $2 million and staff bonus $3 million. Option 4, advertisement cost $0.5 million, staff bonus $3 million. So they have used all combinations. Which option is right? Which option is right? One student, okay. Some students are saying option C is right. Option C is the right answer. As far as advertisement cost is concerned, it will be fully charged to that interim period in which it is incurred. There is no scope of deferment or postponement or preponement. But as far as bonus is concerned, it is based on sales. If two conditions are satisfied, provision for bonus can be recognized in the interim period. Either there is a legal or constructive obligation to pay bonus. There is a legal or constructive obligation to pay bonus. In this example, it appears to be a contractual obligation to pay bonus. And second, amount of bonus can be estimated reliably, which they have reliably estimated 3 million. Therefore, bonus can be recognized in the interim period if it can be reliably estimated. So the two combination must be $2 million for advertisement and $3 million for staff bonus. So that is my answer, option C, tick mark. Those students who have the book, tick mark option C. And now we'll come to one more very important question to check your knowledge in full public view. Okay, see how much you have learned. Let us test your knowledge, how much you have learned in Ind AS 34. An entity prepares quarterly interim financial report in accordance with Ind AS 34. An entity sells electrical goods and normally 5% of the customers claim on their warranty. The provision in the first quarter was calculated as 5% of sales to date, which was $10 million. However, in the second quarter, a design fault was found and warranty claims were expected to be 10% for the whole of the year. Sales in the second quarter was $15 million. What would be the provision charged in the second quarter's interim financial statement? What would be the provision you are going to charge in the second quarter's interim financial statement? Kindly solve. Question number 7 can be asked as a 4-mark question in the exam also. Without option, it is a 4-mark question in the exam. Yes, anybody who would dare to reply? Dare to reply. Dare to reply. What is my total sales? $10 million in the first quarter and $15 million in the second quarter. So total sale is $25 million. Total provision required at the rate 10% now, because my estimation has changed, so it comes to 2.5 million less provision recognized in last quarter, in first quarter. So previous quarter provision we are going to cancel, which is equal to 10 million into 5%, that is equal to 0.5. 0.5 you reverse, 2.5 you will provide. So the charge to the profit and loss will be 2 million. 2.5 minus 0.5. Previous provision was 0.5. Required provision is 2.5. So incremental provision recognized is $2 million. So the answer for this would be $2 million. And I have written the working note. In case if you are interested, you can copy. It can be a 4-mark separate standalone question without the options. You have to provide in the second quarter total provision of 2.5 million based on revised rate 10%. Provision provided in the first quarter was 0.5 million. So previous quarter will be cancelled, fresh provision will be made. So you will have to provide an additional provision of 2 million. Additional provision of 2 million will be provided. So that was the answer of this very, very important question number 7. And these are important questions on Ind AS 34. Is it right? So thank you very much. Good evening friends. Today we will take MCQ on Ind AS 36. What is Ind AS 36? Impairment of assets. So test your knowledge on Ind AS 36 with these MCQs. So first question on your screen. Ind AS 36 shall be applied in accounting for the impairment of all assets other than. So there are 4 choices. One of them is not under the scope of the standard. Which one? Contract asset and asset arising from cost to obtain or fulfill a contract. This is not covered by Ind AS 36. Deferred tax asset not covered by Ind AS 36, covered by Ind AS 12. Inventory covered by Ind AS 2. So the answer is all of the above. So correct answer was D. Very good. Now try question number 2. Ind AS 36 shall be applied in accounting for impairment of all asset other than non-current asset classified as held for sale under Ind AS 105, asset arising from employee benefit, deferred acquisition cost and intangible asset arising from an insurer's contractual right under insurance contract. All the above. Which option is right? All of you can participate. The answer is all of the above. So again, answer is D. Everybody should participate. Answer is D. Check one more similar question. They can ask question from any segment of the standard. These questions are from the scope paragraph. Ind AS 36 shall be applied in accounting for impairment of all assets other than financial assets which are covered in the scope of 109, biological asset Ind AS 41, asset arising from employee benefit, all of the above. Every time don't answer all of the above, but yes, in these three questions we had all of the above. One more time. Ind AS 36 shall be applied in accounting for impairment of all asset other than associate as defined in Ind AS 28, joint venture as defined in Ind AS 111 and subsidiaries as defined in Ind AS 110, and the last option D is none of the above. None of the above. These three will be covered by Ind AS 36. The answer was D. Question number 5. Which of the following statement best describes the carrying value of an asset? So choose the right option from Ind AS 36. The higher of the asset's value in use and its recoverable amount. Is it carrying amount? No. The higher of the assets NRV and its value in use? No. Then the amount at which the asset is recognized in the balance sheet after deducting accumulated depreciation and accumulated impairment loss? Yes. Cost of the asset minus residual value? No. So the correct answer would be C. Very good. Try question number 6. How should an entity allocate goodwill to its cash generating unit for the purpose of impairment testing? Good question. So first you will try, then I will give you the answer. Yes, students, please check which option is the right answer. Which option is the right answer? Which option is the right answer? Come on. The answer would be D, to that cash generating unit which is expected to benefit from the goodwill. In case of goodwill, you have to allocate to that CGU or CGUs which are expected to benefit from the goodwill. So the answer is D. Question number 7. Please try. Which of the following is not an external indicator of impairment? Not an external indicator of impairment. Technological change, external indicator. Decline in assets market value, external indicator. Adverse change in market in which the entity operates, external indicator. But the last one, the asset becoming idle, is an internal indicator. So the correct answer is D. One more chance. Question number 8. Which of the following is not an indicator of impairment? Not an indicator of impairment means out of 4 options, 3 are indicators of impairment. An increase in the interest rate which increases the discount rate. This is an indicator of impairment because value in use will fall. The estimated NRV of inventory has been reduced due to fire damage, although this value is greater than its carrying amount. Point C, we'll see. Point C, advance in technological environment in which an entity is employed because an adverse impact on its future use. It is an indicator. Last point is the carrying amount of an asset's net asset is higher than the entity's number of share in issue multiplied by its share price. Means the book value is greater than market capitalization. The last point means book value is greater than market capitalization. So this is an indication of impairment. The last two are indication of impairment. In case of inventory, it is not an indication of impairment because its value is higher than the carrying amount, not an indicator of impairment. One more, question number 9. As per Ind AS 36, which of the following would definitely not be an indicator of the potential impairment of an asset or group of asset? So again you have to find not an indicator of impairment. Tell me. First one, a significant in technological environment in which the entity operates. Is it an indicator of impairment? Yes. An unexpected fall in the market value of one or more asset. Is it an indicator of impairment? Yes. Carrying amount of an entity's net asset is below the market capitalization. This time the market cap is greater than carrying amount. So this is not an indicator of impairment. Last point, adverse change in the economic performance of one or more asset. So that is an indicator of impairment. So if market capitalization is greater than the book value, it is not an indicator of impairment. One more, question number 10. In accordance with Ind AS 36, which of the following explains the impairment of an asset and how to calculate its recoverable amount? So you will first read the options and give me the answer. Yes, students, please try the last one, question 10. Question 10. All of you are saying C. Okay, the asset is impaired when carrying amount is greater than recoverable amount and recoverable amount is higher of fair value less cost of disposal and its value in use. So you are right, the correct answer was C. Okay, now we'll come to multiple choice questions relating to Ind AS 37. So quickly you will reply. Let us see how much you have understood Ind AS 37. These are some advanced questions. So only if you have a very clear understanding of Ind AS 37, you will be able to answer. So let us start. First question. When can provision be recognized in accordance with Ind AS 37? So option A. When there is a legal obligation arising from a past obligating event, the probability of the outflow of resource is more than remote but less than probable, and a reliable estimate can be made of the amount of the obligation. So students are saying this is not the answer. We'll check later. When there is a present obligation as a result of past event, the outflow of resources is probable and a reliable estimate of the amount can be made. It seems to be okay. So I'll just put a circle here. So this is a possible candidate for our answer. When there is a possible obligation, so the moment you see possible obligation, it can't be provision. When management decides that it is essential that a provision be made for unforeseen circumstances, and keeping in mind this year the profits were enough but next year there may be losses. So this is creative accounting, not allowed. You are doing profit shifting here. So the candidate which is left is, what is the right answer? What is the right answer? B is the right answer. Question number 2. Amazon Inc. has been served a legal notice on 15 December 20x1 by the local Environmental Protection Agency to fit smoke filters in its factory on or before 30th June 20x2, before June 30th of the following year. The cost of fitting the smoke filter is $250,000. How should Amazon Inc. treat this in the financial statement for year ending 31st December 20x1. So option A is recognize a provision of 2,50,000 in the financial statement for the year ended 31st December. Recognize a provision of 1,25,000 in the financial statement for the year ended 31st December 20x1, because the other 50% of the estimated amount will be recognized in the next year in the financial statement. Point C, because Amazon can avoid the future expenditure by changing the method of operation, and thus there is no present obligation for the future expenditure. No provision is required on 31st December, but as there is a possible obligation, this warrants disclosure in the footnotes to the financial statement for the year 31st December. And the last one, ignore this for the purpose of the financial statement for the year ended 31st December, and neither disclose nor provide the estimated amount. So what is your view? All the students are saying A is not right, B is not right, D not right. So what is the right answer? Oh, the color has changed. Very good. C is the right answer, tick mark. Third question. One more chance to show your skill. A competitor has sued an entity for unauthorized use of its patented technology. So the entity has been sued by the competitor. The amount that the entity may be required to pay to the competitor, if the competitor succeeds in the lawsuit, is determinable with reliability, and according to the legal counsel it is less than probable. Less than probable means probability is less than 50%, but more than remote, not zero probability, that an outflow of resources would be needed to meet the obligation. The entity was sued at the year end. Recognize a provision, make a disclosure of the possible obligation in the footnotes to the financial statement, means contingent liability. Make no disclosure, no provision, and wait until the lawsuit is finally decided and then expense the amount paid on settlement. Set aside as an appropriation a contingency reserve. Oh my God. An amount based on best estimate of the possible liability. Did we discuss that we have to create a contingency reserve? No. So what is the right answer? The right answer is B. You will have to make a disclosure of the possible obligation in the footnote, that is in bracket contingent liability. Okay, one more last chance. Point number 4. A factory owned by XYZ was destroyed by fire. XYZ lost an insurance claim for the value of the factory, building, plant, and an amount equal to 1 year's net profit. During the year, there was a number of meetings with the representative of the insurance company. Oh my God, picture. Okay. Finally, before year end, it was decided. So the insurance company has decided that XYZ would receive compensation for 90% of the claim. So those who have the notes, they can highlight, underline this line. There is a hint here. So it was agreed between the two parties that the insurance company would pay 90% of the claim. XYZ received a letter also, underline. This is more confirmation. Only telephonic confirmation is not enough, remember. But a letter received from insurance company is a virtual certainty that the settlement check for that amount had been made, but it was not received before year end. Mail has come first, email, check will come in due course. How should XYZ treat this in its financial statement? Disclose the contingent asset. True or false? False. Because now it is virtual certainty. But wait, there are some interesting options. Wait until next year, when the settlement check is actually received, and not recognize or disclose this receivable at all, since at year end it is a contingent asset. Wrong. See, because the settlement of the claim was conveyed by a letter from the insurance company that also stated that settlement check was in the mail for 90% of the claim, record 90% of the claim as receivable, as it is virtually certain that contingent asset will be received. So this seems to be a right answer. Just wait for one more option. Because the settlement of the claim was conveyed by letter from the insurance company that also stated that settlement check was in the mail for 90% of the claim, they are saying record 100% of the claim. Virtual certainty is only for 90% as a receivable at year end, as it is virtually certain that contingent asset will be received, and adjust the 10% next year when the settlement check is actually received. This is creative accounting. So the correct answer is C. Yes, C is the right answer. Understood? Good evening and welcome to Ind AS 38. Check your knowledge on Ind AS 38 by solving MCQs. So there are few MCQs we are going to take today, and this will be very useful for your exam. It will help you to check your level of preparation also. So are you ready to take this challenge? Yes. On 2nd January 2015, NDA Corp brought a trademark from Induga Corp for rupees 5 lakh. NDA retained an independent consultant who estimated the trademark's remaining life to be 20 years. Its unamortized cost on Induga accounting records were 3,80,000. NDA decided to amortize the trademark over the maximum period allowed. In NDA's December 2015 balance sheet, what amount would be reported as an accumulated amortization? We are in the books of NDA Corp. What will be accumulated amortization on 31st December 2015? Will you take 5 lakh divided by 20 or 3,80,000 divided by 20? You are in the books of NDA, they have purchased it for 5 lakh. So for them the cost is 5 lakh. 5 lakh divided by 20 years, 25,000. Do we have any option 25,000 here? So first you have to do your own calculation and check if there is any option. The answer is yes. But if somebody by mistake takes 3,80,000 and divide by 20, for him also there is an option. Okay. So the correct answer is option C. C is the correct answer. In your book I have written the explanation also, which you can later on read. One more question, number 2. During 2015, NDA Corp incurred costs to develop and produce a routine low-risk computer software product as follows. Completion of the detailed program design. What will you call it? Sorry. This is a planning stage. It is like research and development, research expenditure, P&L account. Cost incurred for coding and testing to establish technological feasibility. Again P&L account. Other coding cost after establishment of technological feasibility. This right side means capitalized, left side means P&L account. Other testing cost incurred after establishment of technological feasibility. Capitalized. Cost of producing Product master for training material. Capitalized. Wait. Duplication of computer software and training material from product master. These are inventory items. Packaging product 500 units. These two will be inventory item which are produced from the master. In NDA Corp December 31, 2015 balance sheet, what amount will be capitalized as software cost? Is it 59,000? Is it appearing as one of the options? 24,000 plus 20 plus 15. So it can come as a 4-mark question also. Then you will not be given the options. And with the option, it can be converted into an MCQ question. So the correct answer is option C, 59,000. And in your book, the explanation is printed, which you will read later as homework. Question number 3, which is a continuation of question number 2. Only last 2 lines we will read. In NDA Corp December 31, 2015 balance sheet, what amount will be reported as inventory? What amount will be reported as inventory? 25 plus 9. Do we have any option? 34,000 there? Yes. So the answer is B. And you can read the explanation for this question printed below. Now we'll go to question number 4. NDA Inc. has 2 patents that have allegedly been infringed by the competitor. After investigation, legal counsel informed that it had a weak case on patent A34. Weak case on patent A34 and a strong case in regard to patent B39. NDA incurred additional legal fees to stop infringement of B19. Both patents have a remaining life of 8 years. How should NDA Limited account for this legal costs relating to the 2 patents? These are the costs incurred to defend your patent. These are not directly attributable costs to bring the patent to the location and condition as intended by the management. So whatever story they will write, you will be firm. You will say both the legal expenses will be expensed. Which is that option? Option B is the right answer. Legal expenses to defend your patent, trademark, copyright, all will be charged to profit and loss account. Question number 5. On 1st January 15, NDA Corp incurred organization cost or preliminary expense of rupees 24,000. What portion of organization cost will be deferred to the year subsequent to 2015? Can we defer organization cost or preliminary expense? What have you studied? This cannot be deferred. They have to be charged to P&L account. So the answer is 0. If you give 0 answer, you will get a positive mark. If you write any positive answer, you will get 0 marks. So the answer was D. You are right. Question number 6. According to Ind AS 38, which one of the following criteria are relevant in determining the useful life of an intangible asset? Which criteria are relevant? Expected usage, residual value, amortization period? None of the above. What will help you to decide the useful life of the asset? Expected usage of the asset. How you are going to use, for how long you are going to use will affect the useful life. So the answer is A. Tick mark A. Next question. According to Ind AS 38, amortization of intangible asset with a finite useful life should commence. Should commence. When should amortization commence? When it is available for use. Is there any option called available for use? Which option? B. Option B. Next, question 8. A newly set up .com entity has engaged you as its financial advisor. The entity has recently completed one of its highly publicized research and development projects and seeks your advice on the accuracy of the following statement made by one of its stakeholder. Which one is it? So you have to check which statement is correct. Cost incurred during the research phase can be capitalized. Is it a correct statement? Wrong statement. Cost incurred during development phase can be capitalized if criteria such as technical feasibility of the project being established are met. Yes. Training cost of technician used in research can be capitalized. No. Designing of jigs and tools qualify as research activities. No. So which is the most appropriate answer out of for this? B is the right answer. Option B. Okay, now try question number 9. Which item listed below does not qualify as an intangible asset? Does not qualify. Computer software is an intangible asset? Yes. Patent? Yes. Copyright? Yes. Notebook computer, is it an intangible asset? The answer is no. So this is the appropriate answer, option D. One more chance. Question number 10. Which of the following items qualify as an intangible asset under Ind AS 38? Will qualify as intangible asset. Advertisement and promotion? No. College tuition fees paid to employees who decide to enroll as an executive in MBA program at Harvard University while working with the company? No. Why are you laughing? See the imagination. Operating losses during initial stages? No. Legal costs paid to intellectual property lawyers to register a patent? Yes. That means you have understood this standard. Now one last chance to demonstrate your skill. Which of the following disclosures is not required by Ind AS? Not required. 3 of them are required, 1 of them is not required. Useful life of intangible asset, required to be disclosed. Reconciliation of carrying amount, required. Contractual commitment for acquisition of intangible asset, again required. Fair value of similar intangible asset used by the competitor, not required. This disclosure is not required, so therefore this is the answer. Any query? Who got all answers right? Very good. Dear student, now we'll take multiple choice question on Ind AS 40 investment property. Are you ready? So let us see how much you have understood Ind AS 40. Check your understanding. First question. An investment property should be measured initially at cost less accumulated impairment, depreciable cost less accumulated impairment, fair value less accumulated impairment. Yes. Cost model at cost. Ting ting ting. The option which will move, that is the right option. Write down A. Tick mark A. Then the applicable Ind AS for a property being constructed or developed for future use as investment property is, read the full options. Constructed or developed as future use as investment property. First, Ind AS 2, inventory until construction is complete, and then it is accounted under Ind AS 40. Then directly Ind AS 40. Then Ind AS 115 until construction is complete, and then it is accounted under Ind AS 40. Point D, Ind AS 16, PP until construction is complete, and then it is accounted under Ind AS 40. The answer of the institute is Ind AS, or any institute which has set this paper is Ind AS 40 should be the answer, because from the very beginning you are sure that property is constructed or developed for future use as investment property. So tick mark B. Tick mark B. Principles of Ind AS 16 will apply for the purpose of calculation of cost. Third question, this is good question. Let us see who will give me the correct answer. Transfer from investment property to property, plant and equipment are appropriate when there is a change of use based on the entity's discretion, only when the entity adopts fair value model. D, entity can never transfer property into another classification. So many students have replied A. Let us ask computer. A is the right answer. One more chance to show your skill. Question number 4. An investment property is derecognized when it is disposed to a third party, it is permanently withdrawn from the use, no future economic benefits are expected, and all of the above. All of the above is the right answer. Very good. Everybody have given D. One last chance to prove your skill on Ind AS 40. An entity has a factory that has been shut down for years due to various reasons, including worker unrest and strike. The entity plans to sell this factory. It should classify the factory as investment property, classify the property as held for sale, classify the property as PP, write off the net book value and disclose that fact in the footnotes to the financial statement. Yes, please reply everybody. Lot of students are saying B. The answer is B, because it is no longer meeting the definition of investment property. The purpose has changed, evidence is there, so you will classify it as held for sale. Although the information was not enough to conclude that Ind AS 105 will apply, because for Ind AS 105 we require more data to come to a conclusion. But based on all the available options, this is the best option. So these were some. Hello and welcome to MCQ on Ind AS 41 Agriculture. So test your understanding of this amazing chapter Ind AS 41 and see how much you have understood. So we have our first MCQ. Which of the following is not dealt with by Ind AS 41? Not dealt by Ind AS 41. Come on. Which is the correct option? The accounting for biological asset. Is it covered by Ind AS 41? You will say yes. Initial measurement of agricultural produce harvested from entity's biological asset. Yes, covered. Processing of agricultural produce after harvesting. This is not covered. Accounting treatment of government grant received in respect of biological asset. This is also covered. So automatically the answer you have to tick mark is point number C. Tick mark C. Tick mark C. Yes. Okay, one more trial. Where there is a long aging or maturation process after harvest. After harvest, the accounting for such products should be dealt with by Ind AS 2 inventory, or Ind AS 41, or Ind AS 16, or Ind AS 40. Unbelievable option, huh? Ind AS 40 investment property. They should have simply given 3 options. You can't give such option. So the answer is B, inventory. One more option, one more question. Generally speaking, biological asset relating to agricultural activities should be measured using at fair value approach. Historical cost approach, no. This is usually not the answer. It is exceptional answer. I have used the word generally here. This is right. NRV is also not right for biological asset. The correct answer is C. Question number 4. Entity A had a plantation forest that is likely to be harvested and sold in 30 years. The income would be accounted for in the following way. First option, no income will be reported until first harvest and sale in 30 years. Right option or wrong option? Wrong. Income should be measured annually and reported using a fair value approach that recognizes and measures biological growth. This seems to be right. Okay, but we'll read the other options also. The eventual sale proceeds should be estimated. Eventual sale proceeds should be estimated and matched to the profit and loss account over 30-year period. Do we have any such provision in this standard? No. This is students' way of Ind AS understanding. Plantation forest should be valued every 5 years. There is no question of every 5 years. It is every year. An increase in value should be shown as gain or loss. Wrong. It's every reporting date you have to do fair value less cost to sale. The correct option, the correct answer was B. If your understanding is clear, you can answer. I have covered everything, okay, which you need. Question number 5. Recording the choice of measurement basis used for valuing biological asset. Regarding the choice of measurement basis, Ind AS 41 sets out several ways of measuring fair value. In our book, we have discussed 7 methods. So this seems to be right. Recommend the use of historical cost. That is the last choice. Current cost. Never. Recommend the use of present value. This is one of the measurement technique only, but that is not recommended. First choice is to find the fair value in the active market, then comparable price, etc. So present value can be used, but that is not the recommended method to begin with. So the correct answer was A. Question number 6. Where the fair value of the biological asset cannot be determined reliably, the biological asset should be measured at cost. Some student will think yes, cost is right, but read the next option, cost less depreciation. Some of you will think, oh, this is also right. They read one more option, cost less depreciation less impairment. This is the most appropriate answer. NRV is not recommended. Option C is the right answer. Next. 7th, a gain or loss arising on initial recognition of a biological asset and change in fair value, estimated point of sale cost of a biological asset should be included in. All gain or loss in this chapter will go to net profit or loss. Okay, net profit or loss for the period. There is no revaluation reserve, there is no capital reserve. There is no separate statement called statement of recognized gain and loss. It is called statement of profit and loss only. Question number 8. Try your luck now. When agricultural produce is harvested, the harvest should be accounted for by using Ind AS 2, inventory or other applicable standard. For this purpose, the cost on the date of harvest will be equal to fair value less cost to sell at the point of harvest. This is the right option. Historical cost is not the answer. Historical cost minus depreciation and market values are not the answers. So the correct answer was A. Question number 9. Contract prices are not necessarily relevant in determining fair value, and the fair value of a biological asset or agricultural produce is not adjusted because of the existence of a contract. We have discussed this line that forward contract or future contract prices are not relevant. So the answer is true. This is a correct statement. Every time you don't have to tick mark false. One more choice. Land that is related to agricultural activity is valued at fair value. Is the option right or wrong? Wrong. Is accordance with Ind AS 16 or Ind AS 40? Yes. At fair value in combination with the biological asset that is being grown on the land. Amazing. Students, Ind AS. at the resale value separate from the biological asset that has been grown on the land. There is no such statement in our standard. Okay, if you have not studied, then you will apply your own Ind AS. So the answer was B. You have to follow Ind AS 16 or Ind AS 40 if it is a leased asset. 11th number, unconditional government grant relating to biological asset that has been measured at fair value less cost to sell. Now first of all, it is unconditional grant, and second, it is measured at FVL CTS. So what have you learned? When the grant becomes receivable, is there any option like this? A. Deferred credit? No. Income? No. When the application is submitted? Wow. If on submission of application, if I start recognizing income, then what I am doing here every day? Shouting, my throat is paining, my voice has changed. People are not able to recognize my voice. I will also just file application, recognize income, file application, recognize income, and then sell my company to Amazon or Flipkart for 2000 crore, go to Cayman Island and rest there. A deferred credit when the grant was approved, or Miami Island probably, that is better. Huh? A. No, I will not go to Goa. 12th number, last question. If a government grant is conditional on certain events, now this is a conditional grant. This set of MCQs have actually revised your entire chapter. Grant will be recognized when income when conditions attached to the grant are met, income when the grant was approved, deferred credit when the grant is approved. So this is A. Once the conditions are met, it will be recognized as income. Only one assumption we are making, that the biological asset is measured at FVL CTS. Biological asset is measured at FVL CTS. So that was the answer of question number 12. Now we are going to take MCQ on Ind AS 101, first time adoption of Ind AS. So let us check your level of preparation on Ind AS 101. First question on your screen. XYZ is a first time adopter under Ind AS 101. The most recent financial statement it presented under its previous gap was that of 31st December 2005. It has adopted Ind AS for the first time and intends to present first Ind AS financial statement as of December 31, 2006. It plans to present 2-year comparative information for the year 2005 and 2004. So this company wants to give 2 comparatives. Yes, it can do it. The question is, the opening Ind AS balance sheet should be prepared on which date? If you are preparing 2 comparative, the opening Ind AS financial statement will be beginning of the earliest comparative period. The earliest comparative period is 2004. So the beginning of 2004 will be 1st January 2004. 1st January 2004. Do we have any answer? Yes. 1st January 2004. This option you tick mark. Beginning of 2004. This question has 31st December as year ending date. So the answer is beginning of 2004. It was December 31st as year ending date. Had it been 31st March as year ending date, then the answer would have been 1st April 2003. Okay, so answer is C. One more question I will take on Ind AS 101. Which of the following is not a requirement of adjustment in preparing the opening Ind AS balance sheet? Not requirement. 1. Recognize all assets and liabilities whose recognition is required under Ind AS. Second, recognize items as assets or liabilities if Ind AS do not permit such a derecognition. So first is recognize, yes. Derecognize, yes. Third one, think and answer. Disclose as comparative information all figures under previous GAAP alongside figures for the current year presented under Ind AS. And fourth, measure all recognized assets and liabilities according to principle contained in Ind AS. What is the answer? The answer is these three are right: recognize, derecognize, reclassify and measurement. Okay, recognize, derecognize, reclassify, measurement. These three are right. This is not a required disclosure, required adjustment. It is not an adjustment in preparing opening balance sheet. So point number C would be the answer. You have to tick mark. Okay, so these were few questions. Welcome to Ind AS 102 multiple choice question. Some of the very important questions we are going to take. Please participate and see how much you are prepared on Ind AS 102. These are likely questions for your exam also. Which of the following transactions involve the issue of shares does not come within the share based payment under Ind AS 102? So read the options and tell me which does not come under the scope of Ind AS 102. Most of the students have replied option C. Option C, share based payment relating to acquisition of subsidiary. This is not covered by Ind AS 102. Employee share purchase plan, employee share option, share appreciation rights are covered. Very good answer. Tick mark option C. Tick mark option C. Now come to question number 2. Which of the following is true regarding requirement of Ind AS 102? Private companies are exempt. Small companies are exempt. Subsidiaries using their parents' equity share for consideration of goods and services are exempt. And point number D, there is no exemption from Ind AS 102. Most of the students have replied D. Very good answer. Tick mark D. None of the above three companies are exempted from the requirement of Ind AS 102. If they come under the purview of Ind AS 102, they will have to apply Ind AS 102 fully. Now we'll come to question number 3. An entity issues shares as consideration for purchase of inventory. The shares were issued on 1st January 2004. The inventory is eventually sold on 31st December 2005. The value of the inventory on 1st January 2004 was 3 million. Fair value of the goods received was 3 million. This value was unchanged up to the date of sale. The sale proceeds were $5 million. The shares issued have a market value of $3.2 million. Fair value of inventory is 3 million. Fair value of the share issued is 3.2 million. Question is, this can be your 4-mark exam question also. Without option, it can be a 4 marks theory question. Which of the following statement correctly describes the accounting treatment of this share-based payment transaction? Come on student, try yourself. Try yourself. Try yourself. Some students are replying option A. The correct answer is option A. Fair value of the inventory will be taken. So entry will be inventory account debit to SBP reserve account. I'll explain. Inventory account debit to SBP reserve account. Inventory will increase. SBP reserve means equity will increase, and whenever the inventory will be sold, it will be expensed. Here they have taken fair value of equity, but we have discussed first priority will give to fair value of goods received. If that is not reliable, then we'll take fair value of the equity instrument. And why this is wrong? This is wrong because they have written 2 year. There is no such concept. Same thing over here also. 2 year. Here both the figures are wrong. Amount is also wrong. Treatment is also wrong. So that was a wrong answer. Only on answer A was right. Okay, try one more question. Without option, it can be a 4-mark theory question. An entity issues fully paid shares to 200 employees on December 31, 2004. Normally, shares issued to employee vest over a 2-year period, but these shares have been given as bonus to employees because of their exceptional performance during the year. So these are already vested options. These are already vested shares. The shares have a market value of 5 lakh on December 31, 2004. The average fair value is 6 lakh. What amount would be expensed in the income statement for the above share based payment transaction? A very good question. Whatever you will think, there is an option for that. If you think the answer is 6 lakh, you have an option 6 lakh. If you think answer is 5 lakh, there is an option 5 lakh. And if you want to divide by 2, you have 3 lakh and 2 lakh 50,000. So please reply. Some students are saying option B. Option B is the fair value of the share on the grant date. That is right. We don't have to take average share. And because these are vested options, I don't have to divide by 2 also. Tick mark B. Tick mark B. Now we'll come to last MCQ for this chapter. Question number 5. An entity grants 1000 share options to each of its 5 directors. Underline number of directors. On July 1, 2004, the option will vest on June 30, 2004. So vesting period is 4 years. And now the question says the fair value of the each option on grant date is 5. So 1000 into 5 directors into fair value 5. It is anticipated that all the share options will vest on June 30, 2008. What will be accounting entry in the financial statement for the year ended 30th June 2005, first year? Total estimated expense divide by 4 years. Can you do this calculation and tell me how much will this be? 6250. So I have to record an expense of 6250, credit SBP reserve 6250, check whether there is any option like this. So this will be eliminated, this will be eliminated. Now we have to make a choice between A and C. Even A will be eliminated. A talks about 25,000. So if I use elimination process, only option C will remain. Entry will be employee compensation expense account debit 6250 to SBP reserve account 6250. So this answer only possibility is option C. Tick mark option C. So today we'll take Ind AS 103 MCQ. Test your knowledge of Ind AS 103 MCQ. This will cover a lot of questions from different aspects of Ind AS 103 and you will be able to check for yourself how much you are prepared. First question on your screen. Company P owns and operates restaurant groups in various metropolitan area. P acquires Company S, a group of 10 restaurants located in a major city. The acquired set of activities and assets include land, leased asset and leasehold improvement, equipment and the right to trade name used by the restaurant group. P also offers employment to the restaurant's employees, including management level employees, service staff and chef, but P does not acquire S procurement system used to purchase the food, drinks and other supplies necessary to operate the restaurant. State whether the acquisition will be accounted for as a business combination. Good question. It can come for 4 marks also if there are no options given. So what is your answer? Can we call it as a business combination? There is input also, substantive process also, output also. But there is one process which is not taken over, procurement system. Is it necessary that you have to acquire every process? Those processes which can be easily replicated from outside, or in case Company P already has a procurement system which they can use. So there is no need to acquire procurement system and still it will be called as a business combination. So what is the right answer? Seems to be right. Option B is the right answer. Question number 2. Which of the following accounting methods must be applied to all business combination under Ind AS 103? Which accounting method must be applied for all business combination under Ind AS 103? Purchase method, proportionate consolidation, equity method or pooling of interest method? So the answer is purchase method. Pooling of interest method we apply only for common control transaction. Equity method we apply for associates and joint venture. Proportionate consolidation method is not there. It is applied only for joint operation. And this method is applied for business combination. So the correct answer, tick mark, is D. Question number 3. Purchase accounting requires an acquirer and an acquiree to be identified for every business combination where a new entity H is created to acquire two pre-existing entities S and A. Which of these entities will be designated as the acquirer? Which of the entities will be designated as the acquirer? Question has not given complete information. Who will control whom? Who will get a better stake in that company or higher stake in that company? So usually one of the two will get more stake in that company and therefore the company which will get a higher share can be treated as the acquirer. So the answer can be H also, or the answer can be A or S also. Two answers are possible for this question. If more information was given, we could have answered it. So you tick mark D. The one who will get more stake in that company will be treated as acquirer. Then you come to question number 4. Which of the following examples is unlikely to meet the definition of intangible asset for the purpose of Ind AS 103? Which of the following is not likely to meet the definition of intangible asset? Think and answer. Marketing related, such as trademark and internet domain name, customer related such as customer list and contracts, technology based such as software and database, and D, pure research based such as general expenditure on research. General expenditure on research will not be classified as intangible asset. So the answer is D. Although research asset can be taken over if it meets the definition of business. If it meets the definition of business, there is input and substantive process which have the capability to produce output. General research expense will not be treated as intangible asset. Question number 5. An acquirer should, at the acquisition date, recognize goodwill acquired in a business combination as an asset. Goodwill should be accounted for as follows. Option A, recognize as an intangible asset and amortize over its useful life. Do we amortize goodwill? Write-off against retained earning? No. Recognize as intangible asset. An impairment test when a trigger event occurs? No. Goodwill is to be tested for impairment annually or more frequently if impairment is indicated. So therefore the correct answer is D. Yes, the answer D was right. Question number 6. Please participate. If the impairment of the value of goodwill is seen to have reversed, suppose you think goodwill impairment is reversed, then the company may reverse the impairment charge and credit income for the period. Goodwill impairment cannot be reversed. Reverse the impairment charge, credit to whatever, whenever they see reverse, it is a wrong option. Not reverse the impairment charge. Goodwill impairment is not reverse. Reverse the impairment charge only if the original circumstances blah blah blah. Reversal is not allowed only. It will amount to creating self-generated goodwill. Whenever they talk about reversal, that option is wrong. The correct answer is option C. Question number 7. Ind AS 103 requires that the contingent liability of the acquired entity should be recognized in the balance sheet at fair value. The existence of contingent liability is often reflected in a lower purchase price. The existence of a contingent liability is often reflected in a lower purchase price. Recognition of such contingent liability will. So what will be the effect of recognizing contingent liability? It will decrease the value attributable to goodwill, thus decreasing the risk of impairment of goodwill. Decrease the value attributed to goodwill, thus increasing the risk of impairment of goodwill. Increase the value attributable to goodwill, thus decreasing the risk of impairment of goodwill. Increase the value attributable to goodwill, thus increasing the risk of impairment of goodwill. Only if you can visualize the treatment, you will be able to answer. What is the treatment for business combination? Asset account debit, two liabilities, two consideration. First to understand this much. And balancing figure is goodwill. If I add one more liability here, contingent liability, goodwill will increase. So first we will eliminate those options which have decreased the value of goodwill. Now we have two options left, C and D. Increase the value of goodwill, but if goodwill value increases, risk of impairment will also increase. The risk of impairment will also increase. Let us see whether the answer is D. Yes, this is called applying intelligence and elimination method also. There is one question number 8 in our book, but that will require some correction. Two correction, one line you have to add in that question. One line you have to add in the question. Here, measure NCI at fair value. Second correction you have to write in the option given here. This option you rectify. I think in your book some different figure is there. Make it 12.5 million. Now let us read the question. Entity A purchases 30% of the ordinary share capital of entity B for $10 million on 1st January 2004. First lot was purchased on 1st January, 30%. And how much consideration was paid? 10 million. The fair value of the asset of entity B at that date was 20 million. So that time it was 20 million. On 1st January 2005, entity A purchased a further 40% of equity of entity B for $15 million. So for 40%, they have paid 15 million. Is it right? So we have to revalue the previously held 30% also. What will be the value of that 30% stake now? For 40% stake, you have paid 15 million. So we have to revalue the previously held equity interest. How much? 11.25. Revaluation of previously held equity interest. Plus we have to also add NCI. NCI is also holding 30%. NCI will also be fair valued. NCI will also be fair valued. So the total value of consideration plus NCI is how much? 37.5. What is the fair value of identifiable net asset? 25 million. Identifiable net asset INA is 25 million. Now it says on 1st January 2004, entity A does not have significant influence over entity B. What value would be recognized for goodwill before any impairment test in the CFS for the year ended 31st December 2005? So what would be the value for goodwill? Is it 12.5? You can mention the calculation also, left side, right side in your book if you want. So this itself can be a 4-mark question to identify goodwill. 12.5 million. Option C, calculation I have disclosed. Okay, try one more question. In MCQ it will be 1 mark, otherwise it can be a 4-mark question separately. Question number 9. Corin, a private limited company, has acquired 100% of coal, a private limited company, on 1st January 2005. The fair value of the purchase consideration was $10 million ordinary shares of $1 of Corin, and the fair value of the net asset acquired was $7 million. At the time of acquisition, the value of ordinary share of Corin and the net asset of coal was only provisionally determined. So my question is, what was provisional goodwill? 10 is the PC, 7 is the net asset, so goodwill is 3, there is no NCI. The value of Corin Limited, where were we? The value of shares of Corin Limited 11 million and the net asset of coal 7.5 million on 1st January 2005 were finally determined on November 30, 2005. However, the directors of Corin have seen the value of company decline since January 1, 2005, and as of February 1, 2006 wish to change the value of purchase consideration to 9 million. What value should be placed on purchase consideration and net asset of coal as on the date of acquisition? What is the date of acquisition? 1st January 2005. measurement period is 1 year. That means up to, let us say, 1st January 2006 you can make adjustment. And they have found that the value of these shares of Coal Limited and net asset of coal was 7.5 million, and this they have determined was on 30th November. 30th November 2005 is within the measurement period. So that value we can take that value, but the value changed after 1st January, that is February 1, 2006, is outside the measurement period. So those value will not be considered. Is it right? So now you have to see the answer which contains 11 and 7.5. Which option has 11 and 7.5? Option B. Option B has 11 and 7.5. PC will be changed. All figures can be changed, okay, within measurement period if it relates to a condition already existing on the date of acquisition. And the net asset value will be revised to 7.5 million. Wherever 9 is there, that is a wrong answer. 9 cannot be the answer. So at least you can eliminate 9. And then you can't have a combination which does not have 11 and 7.5. Only 11 but not 7.5, wrong. And this is provisional figure. Provisional figure we will not take. In case if you are able to find the correct value within the measurement period, those figures will be taken.
On the date of acquisition still we record 10 and 7.
On the date of acquisition, but the question is what value should be placed on purchase consideration and net asset of coal. We can do the provisional, but then for accounting purpose we are going to change those figures on 30th November. But for the purpose of goodwill calculation, this figure will be relevant. Is it right? We are allowed to change the provisional figure within 12 months from the date of acquisition. So the intention of the question is what finally you will take as cost of acquisition and net asset value for the purpose of accounting. Otherwise there was no need to give so much information. If you have to take it literally, what was the value on the date of acquisition, then first 2 lines are enough. The purpose is that you have to apply measurement period concept and answer this question. Maybe the drafting may not be as accurate as it should be. So the answer is B. We'll come to last question, number 10. Question number 10, again try yourself. Mask, a private limited company, has arranged for MAN, a public limited company, to acquire it as a means of obtaining a stock exchange listing. MAN issues 15 million shares to acquire the whole of share capital of Mask, 6 million shares. The fair value of the net asset of Mask and MAN are 30 million and 18 million respectively. The fair value of each of the share of Mask is $6 and the quoted market price of MAN share is $2. The share capital of MAN is 25 million shares after the acquisition. Calculate the value of the goodwill in the above acquisition. Calculate the value of the goodwill in the above acquisition. Does it look like a reverse acquisition question? It looks like a reverse acquisition. Total number of share is 25. Share issued to other companies 15. So now the breakup will be the acquiring company, legal acquiring, will be holding 60% share, and the legal acquirer will be holding 40% share. So this is a case of reverse merger, reverse acquisition. In case of reverse acquisition, the accounting acquirer will be masked. Accounting acquirer will be masked and accounting acquiree will be man. So you'll have to see what is the fair value of man. What is the fair value of man? One share is $2 million. How many shares were there before fair value of the net asset is 18 million. Purchase consideration will be the share capital of man is 25 million after the acquisition. How many shares Man Limited had before acquisition? 10 into 2 is how much? 20. And the asset is how much? 18 million. 20 minus 18.
The man issues 15 million shares. The purchase consideration 15 million into
15 into 2. 15 into 2.
That 30 million is purchase consideration.
30.
And
net asset?
18.
18.
So 12 million is equal.
12. Let me see. The answer is not 12. Sorry.
No, the 6 million shares are issued, no?
6 million shares.
Oh,
It's given a 50 million shares profile. Share capital of not 6 million.
share ratio can be different.
Please try. Number of shares of Man Limited before this is not given clearly. They are saying total number of shares is 25 million in issue. 15 million shares were issued. So if it is a reverse acquisition, the value of Man Limited will be 10 million into 2. Total number of share before merger was 10 into 2, 20 minus net asset 18. So the answer should be 2 million.
I think they have done 36 minus 30.
36 minus 30 they have done. Normal calculation.
So they have not considered reverse acquisition.
They have not considered. Okay, so this question I'll just keep pending. I'll think about it. 10th number you keep it on hold. Okay. Dear students, today we are going to take MCQ on Ind AS 105, non-current asset held for sale and discontinued operation. So are you ready for this challenge? Check how much you have understood Ind AS 105. I will take difficult questions and this will help you to evaluate your preparation for Ind AS 105. Question number 1. How should the income from discontinued operation be presented in the income statement? Choose the option and tell me the answer. The entity should disclose a single amount on the face of the income statement with analysis in the notes or a section of the income statement. Second option B, amount from discontinued operation should be broken down over each category of revenue and expense. Third is discontinued operation should be shown as a movement on retained earning. Unbelievable option. But some 5-10% people will tick that also. Point D, discontinued operation should be shown as a line item after gross profit with the taxation being shown as a part of income tax expense. Which option is right? D. There is no question of gross profit in the income statement. In which corporate P&L account do you see gross profit? We write revenue, other income, total income, all expenditure, PBT. Where is gross profit? So this is wrong. This is wrong because you don't have to give the breakup of each category of revenue and expense. It is presented as a single item, single amount on the face of income statement. So you have to only write profit or loss from discontinued operation.
Single item is only one.
Yes, actually you should give profit or loss before tax and tax expense. But these three options are totally wrong. There is no gross profit shown in income statement. You can't make that blunder. So tick mark option A. You can show discontinued operation, profit or loss as a single item. You don't have to write revenue expense separately on the profit and loss account. Okay, try your luck next time. Question number 2. Everybody, how should the asset and liability of a disposal group classified as held for sale be shown in the balance sheet? The assets and liabilities should be offset and presented as a single amount. Can we do offsetting? No. First option is wrong. The assets and liability of disposal group should be shown separately from other assets in the balance sheet, and the liability of the disposal group should be shown separately from other liabilities in the balance sheet. This seems to be correct, so I'll keep it on hold because I need to read other options also. There can be better option also. The assets and liabilities should be presented as a single amount and as a deduction from equity. This is students' Ind AS. There should be no separate disclosure of assets and liabilities of a disposal group. This is also wrong. So eliminate the wrong answers. 3 answers are completely wrong, but only if you have read the standard. Otherwise you will write students Ind AS. Question number 3. This can come as a 4-mark question also in the exam without options. Okay. An entity is planning to dispose of collection of asset. The entity designates this asset as a disposal group. Everybody should participate. The carrying amount of this asset immediately before classification as held for sale was $20 million. So carrying amount 20. Upon being classified as held for sale, the assets were revalued to 18 million. The entity feels that it would cost $1 million to sell the disposal group. So that means your FVLCTS will be 17. Then it says what would be the carrying amount of the disposal group in the entity's account after its classification as held for sale. So we will take lower of the two. Which figure is lower of the two? 17. Do we have any option? First you have to don't look at the option. For a numerical question you have to do yourself roughly and see if any option contains your answer. If yes, the chances are that would be right, but not always, because whatever you will imagine, there is an option for that. Suppose you think 20 is there. Suppose you think 18 is there. Some of the great student can add 18 plus 1 also. So 19 is also there. Or some of them deduct 1 from 20. So whatever you will visualize, a good examiner will put all those options in the answer. 17 is right. Okay, try one more. This can come as a 4-mark question in the exam without options, or 2-mark question. An entity is planning to dispose of a collection of assets. The entity designates this asset as a disposal group. and the carrying amount of the asset immediately before classification as held for sale was 20 million. Upon being classified as held for sale, the assets were revalued at 18 million, that is fair value. An entity feel that fair value less cost to sell will be 17 million. So 20 versus 17. How would the reduction in value will be treated in financial statement? So we have to show 17 in balance sheet. You have to write off 3. What is the treatment of that? So we'll first play elimination route. Entity should recognize a loss of $2 million immediately before classification as held for sale, and then recognize an impairment loss of $1 million. Entity should recognize an impairment loss of 3 million. Entity should recognize an impairment loss of 2 million. Entity should recognize a loss of $3 million immediately before classifying the disposal group as held for sale. Option A. Why?
Because when we revalue the downward evaluation,
First revaluation and then P&L account. But who says that the entity follows revaluation model? Upon being classified as held for sale, the assets were revalued at $18 million. So that was the fair value. That was the fair value. What is written? The carrying amount of this asset immediately before classification as held for sale was 20 million. So 20 million is the updated carrying amount. 20 million is updated carrying amount. Okay. And they have revalued it to 18 million. So entity will recognize a loss of $2 million immediately before classification as held for sale. So that is under Ind AS 16. Interpretation issue. They have revalued it to 18 million. So 2 million will be revaluation loss under Ind AS 16. 1 million loss will be under Ind AS 105. In any case, the answer would be total loss of 3 million will go to profit and loss account. But of course, we will assume that the asset is carried at revaluation model. Now next question number 5 is easy on your brain. In order for a non-current asset to be classified as held for sale, the sale must be highly probable. Highly probable means that the future sale is likely to occur, future sale is more likely than not to occur, and the sale is certain. The probability is higher than, more likely than not. We have discussed the definition. Higher probability means the probability much more than 50%. More likely than not is more than 50%. Highly probable means much more than that. So which is the answer? The last one, probability, because they have said probability. You can see the definition in the second page of our chapter. Tick mark D. Tick mark D. You will come to the class is probable. I will come to the class is highly probable. Understood? You have a choice. See, some students are absent today, online also, offline also, but I am there.
Independence Day weekend.
Question number 6. An entity acquires a subsidiary exclusively with a view to selling it. The subsidiary meets the criteria to be classified as held for sale. At the balance sheet date, subsidiary has not been sold and 6 months have passed since its acquisition. How will the subsidiary be valued in the balance sheet at the date of first financial statement after acquisition? How will the subsidiary be valued in the balance sheet at the date of first financial statement after acquisition? At fair value, at FVL CTS, at carrying amount, or in accordance with the applicable Ind AS? The answer is B, because now it will be taken care of by Ind AS 105. A subsidiary held for disposal is also treated under Ind AS 105. So then it will be FVL CTS. Question number 7. Please reply everybody. Any gain on a subsequent increase in fair value less cost to sell of a non-current asset classified as held for sale should be treated as follows. Gain should not be recognized in full. Gain should not be recognized. Gain should be recognized but not in excess of the cumulative impairment loss. Gain can be recognized but not in excess of the cumulative impairment loss that we have provided, and gain should be recognized only in the retained earning. Last one is wrong. First one is wrong. B is also wrong. So there is a paragraph in the notes also. Gain will be recognized but not in excess of cumulative impairment loss. Although we did not have a question on that. Question number 8. Question number 8. An entity has an asset that was classified as held for sale. However, the criteria for it to remain as held for sale no longer apply. So this is a reverse of held for sale. What will you do when the criteria no longer apply? The entity should leave the non-current asset in the financial statement at its current carrying amount. Wrong. Remeasure the non-current asset at fair value. Wrong. Measure the non-current asset at the lower of the carrying amount before the asset was classified as held for sale as adjustment for depreciation, amortization, revaluation and its recoverable amount. So this is correct answer, because once you decide that the asset is no longer held for sale, it will be valued at lower of the two. Carrying amount, if there was no depreciation, amortization, if there was no classification as held for sale. So forget for the timing that there was held for sale accounting followed. Go to that date when you had classified it as held for sale. Provide depreciation, amortization, revaluation, impairment loss or recoverable amount, whichever is lower. So this seems to be right. Recognize the non-current asset at its carrying amount prior to its classification as held for sale as adjusted for subsequent amortization revaluation. This is half of the answer. We have to also compare with the recoverable amount. So this option is also wrong. The correct option is C. Tick, tick. Question number 9. Which of the following criteria do not have to be met in order for an operation to be classified as discontinued? Which criteria is not required to be met? Means out of 4, 3 criteria are to be met. So tell me, the operation should represent a separate line of business or geographical area. The answer is yes. The operation is a part of single plant to dispose of a separate major line of business. The operation can be a subsidiary exclusively acquired with a view to resale. Yes. The operation must be sold within 3 months of the year end. There is no such requirement. Within 1 year from the date of classification as held for sale. So that is a wrong option, and therefore tick tick D. One more chance, last chance to show your skill. Ind AS 105 states that a non-current asset that is to be abandoned. If the non-current asset is to be abandoned, it will not be classified as held for sale. Non-current asset which is to be abandoned is also treated like held for use only, and Ind AS 16 will apply. The reason for this is because the carrying amount will be recovered principally through continuing use, It is difficult to value, wrong option. It is unlikely that non-current asset will be sold within 12 months, wrong option. It is unlikely that there will be an active market for a non-current asset. Three options are totally far away from the real answer. So it is assumed that the carrying amount will be recovered through the use, and Ind AS 16 will apply. So that was also a good question. So with this wonderful solve other questions as home exercise.
One question 30 is also.
30 homework. Question number 30 homework. Now all the student, please come to this MCQ on Ind AS 108 and test your understanding of Ind AS 108. Are you ready for this challenge? Yes. Ind AS 108 is operating segment. So let us check your understanding. Expect such questions in the exam, and this can itself be a 4-mark question also without the options. Understood? If they remove the option, it will become a 4-mark question. An entity manufactures suits, clothing, bed linen and various cotton and man-made fiber products. It has several segments which are reported internally as. So what are the segments? They have suits, shirts, bed linen, blinds, cloth, and then they have given you sales. So if you look at it, this will be reportable segments. If you look at the profit, this 1, 2, 3 will become a reportable segment independently. This will become a reportable segment if I only apply 10% criteria. The table represents the percentage of sale, profit and asset that are attributable to the different segments. So that they have bifurcated it for you. The entity wants to present bed linen and cloth as single segment. Where is bed linen? This, and cloth, because their economic characteristics are same and most of the features are also same type of customer, same type of product or service, same type of distribution network, same type of regulatory environment. So can they combine these two as one? But is wondering whether the information can be aggregated. That is the question. Can you aggregate bed linen and cloth as one segment? That is the question. I will ask you. Keep thinking. How will the segment information be presented in the financial statement? If suppose there is no options, it will become a 4-mark question. And let us see with option what would be the answer. So option A, this bed linen and cloth, which they want to merge as one segment, aggregate as one, suits, shirts, and shirts will be shown as separate segment and blinds in the other category. So let us see whether suits and shirts they qualify. Yes, they have 10% and blind does not satisfy any of the 10% criteria, and the management wants to aggregate these two, which you have to read Ind AS 108 to get the answer. Can they be aggregated? Okay. Then second option B, all the segments should be presented separately. Now that cannot be the answer because blinds do not meet any of the 10% requirement. Suits, shirts and bed linen will be separate segment with blind and clothes shown as single segment. Blind and cloth. Blind and cloth. Last two, they can be shown in other segment. Is it right? And last D, option D. So this is a potential right answer This is a potential right answer. B we have eliminated. Then suits and clothes will be one segment with shirt, bed linen and blind shown as other separate segment. This cannot be the answer because bed linen has got 10% or above sale, 10% or more profit. So it has to be separately disclosed. So now the choice is between A and C, A and C, A and C. A, C. Anup Bapat A and Ajit Pawar what? C. Vima A. Yes, Nikki A. A. C. So democratic process, more votes go for A. So the answer is A. Write down A. See, some minutes before we have discussed that company can aggregate some segment which are similar in economic characteristic and majority of the aggregate criteria are same. So cloth and bed linen are not something very different product from each other. So if management wants, they can aggregate cloth with bed linen also. It can be done because they have similar economic characteristic, they share aggregate criteria, so that can be done. So the answer is A.
Cloth can have similar characteristics with all of them.
Cloth, but management wants to merge like that, so management have that discretion. It have similar characteristic to suits also, shirts also, but management says I want this particular way of reporting. The CEO DM may say I want this particular way of reporting, so that can be done.
Quantitative thresholds we found
That is not required. If you want to, I have shown you, I think, I don't know whether you were present or not at that point of time. Even if a segment does not meet 10% threshold, it can be aggregated with other segment if it has similar economic characteristic and majority of the aggregation criteria are same. So if you look at it, the nature of product and services are similar. I am not saying same, but similar. Type or class of customer, similar. Production method, similar. Distribution channel, similar. Regulatory environment, maybe same only. So majority of the criteria are same. So if they want, they can aggregate, and that is the right answer. You can't force them that no, this cannot be done. It is right. Management has got lot of discretion in this standard. As long as you are within the definitions and the provision of the standard, you can do it. So answer was A. No problem. One more chance. So one more chance, try your luck. An entity operates in the gas industry and has 4 different productive processes. Within the production cycle, it is essentially a vertically integrated business. Vertically integrated means output of one becomes input for the next process. The entity proposes to disclose segment information regarding each of the 4 operations. So there are 4 segments and they want to disclose about each of them. Can the entity disclose separately as operating segments the 4 operations within the production cycle? Can you disclose separately as operating segment 4 operations within the production cycle? Well, you have got 4 choices, you have to answer within that limit only. No own interest idea. These are the options, choose one of them. So the first answer is no, it must show a single segment covering all the various operations. B, Ind AS 108 says it is compulsory to show each different operation separately. C. Ind AS 108 encourages voluntary disclosure of the segment and it is considered to be a good practice. And D. The entities should group together various operations and show exploration, production and chemical as one segment and retailing as other segment. And from where did they get this segment, chemical, retailing? It's not in the problem, but maybe these four processes are exploration, production, chemical and retailing. Yes, vote now. Voting starts. Sure. How many of you are saying A? None of you are saying A. 100% votes go to option C. C is the right answer. And if you can answer this question, you have understood this standard. Okay. Next, question number 3. MS Limited follows Ind AS for its financial reporting. The CODM of the company reviews all of its segment assets and liabilities based on their fair values. Can CODM review on fair value? Yes, we'll see yes or no. The recently joined finance manager of the company has sought your advice on the preparation of the financial statement of the company. You are required to select the correct answer from the below mentioned options. Oh my God. Who will read so much? You will read, you are a student. Point A. So this is very advanced level MCQ. Okay. In the this kind of question they ask in when I appeared for CPA exam, the options were like this. So it was very difficult to choose the option. They were so close that you really need to know your concepts very well. In the operating segment disclosure, the assets and liabilities should be disclosed at the amount reported in the balance sheet. So if you think it is wrong, let us do the elimination. This is wrong because you don't have to report as per balance sheet. You can have different measurement basis. A disclosure should be given, so that is wrong. In the operating segment disclosure, let us read point B. The asset and liabilities should be disclosed at the amount reported in balance sheet. Again wrong. Point C. In the operating segment, asset and liabilities should be disclosed at the fair value being reviewed by the CODM. The company should present a reconciliation between the amount disclosed and the operating segment disclosure and the amount reported in the balance sheet. This seems to be right, so I will keep it on hold. In the operating segment, you should read the fourth answer also. Sometimes fourth is a better answer than the third one. In the operating segment disclosure, assets and liabilities should be disclosed at the fair value reviewed by CODM. Up to this is right. The company should provide a note in the financial statement that the amount disclosed under operating segment disclosures are at fair value, where the amount reported under balance sheet are measured based on their nature and classification. A quantitative reconciliation is not required. Because of this line, it is wrong. So you can answer like this also. If you are sure what is wrong, first cancel it. So the answer write down is C. One more chance. Question number 4. Frames Limited prepares segment information for its management reporting purpose. Under Ind AS 108, just make it 108, operating segment, the company can also use this segment information to determine the appropriate segment for financial reporting. Applying this approach, which of these are frames reportable segment under Ind AS 108? So let us look at the answer and give reasons in brief. Everything is printed. Now there are 5 options. Oh my God. Segment deemed significant by the management and are reviewed regularly by them. Option B. Segment whose information is presented by Frames Limited industry peers. Can it be the answer? So whatever you think is totally wrong, first you eliminate, because Every company is free to determine their own operating segment. Then point C, each segment whose operating results are reviewed regularly by the board of directors of Frame Limited to make decision about resources to be allocated to the segment. Right or wrong? Wrong. Board of director is not required. CODM is required. Board can be CODM, but let us read the other options also. Each segment whose operating results are reviewed regularly by the MD, who is the CODM, to make decisions about resources to be allocated to the segment. Seems to be right? So I will keep it on hold. Let us read D also. Segment whose operating results are covered by the vice president who reports directly to the president of Frame. Totally wrong. What about A? Why can't A be the answer? Segment deemed significant by the management. Management they have written and are regularly reviewed by them, but not only reviewed, one has to also take resource allocation decision, assessment of performance. So D is the right answer. Write down D. D is the right answer. Dear students, please come to MCQ on Ind AS 109 and check how much you are prepared for these MCQs. First of all, 109 is a very important standard. All of you know that. And through these MCQs, we will have a quick revision of 109. Question number 1. Which of the following is not a category of financial asset as defined in Ind AS 109? Not a financial asset. Yes, please reply. Which is not a financial asset? FVT PL, FVT OCI, FV at amortized cost, loans and receivable. Please tick mark the right option. What do you think? Option A, B, C or D, which is not a category of financial asset? Please answer carefully. It is a financial asset. FVTPL is a category of financial asset. FVTOCI is a category. Debt instrument can be treated as FVTOCI. Okay, equity instrument can also be treated as FVTOCI. Debt instrument can be treated at amortized cost also. There is no category. There is no category called loans and receivable. It can be one of the three above, but it is not a category as such. The answer was D. Please tick mark option D. Question number 2. What is the principle for recognition of a financial asset or a financial liability in Ind AS 109? What is the principle for recognition of a financial asset or a financial liability in Ind AS 109? Keep a score also. Keep a score also. We'll see who has got the highest. And you will count only your first answer that you have given. Yes, please reply this answer. Read the question from the screen. Which one do you think is right? Anybody answer? You will mention question number also, because if reply comes a little late. Okay, many students have answered D. The answer is D, because a financial asset is recognized when and only when entity becomes party to the contractual provisions of the instrument. That is what is written in Ind AS 109. Very good answer. Tick mark. Give yourself 1 mark. Question number 3. In which of the following circumstances Derecognition of financial asset is not appropriate. Derecognition of financial asset is not appropriate. Read the options and give me the answer. Read the options and give me the answer. The answer is C. You are right. The financial asset has been transferred and the entity has retained significant risk and reward of ownership. In this case, derecognition is not appropriate. In other three cases, the entity can derecognize the financial asset. You are right. Option C. Very good answer. That shows your understanding. Question 4. Which of the following transfers of financial asset qualifies for derecognition? Qualifies for derecognition. Think and answer. I am also thinking. Most of the students have answered A. Answer A is right. If there is an option to buy back the asset at its current fair value, then you can derecognize. In other three cases, you will not derecognize. These are special cases where you will not derecognize. You are either taking all the risk and reward on yourself only, or the instrument are designed just for borrowing and lending arrangement, not for genuine sale. So answer A, tick mark. Question number 5. These are some very good questions I have found from reference books. Which of the following is not a relevant consideration? Not a relevant consideration when evaluating whether to derecognize a financial liability. Whether the option has been discharged, whether the obligation has been discharged, whether the obligation has been cancelled, whether the obligation has expired, whether substantially all the risk and reward of obligation have been transferred. Out of these four options, three factors are relevant for derecognition. One of them is not relevant. This is very easy question. Yes, come on. We are talking about financial liability, not financial asset. You can think again. In financial liability, we don't have to check this one. This is checked at the time of derecognition of financial asset. Okay. So the answer was D. The correct answer was D. This is for financial asset, not for financial liability. For financial liability, we have to check these three factors. Answer D. Question number 6 in front of you. Very important question. At what amount is a financial asset or financial liability measured on initial recognition? Very basic question. Financial asset or financial liability measured on initial recognition. And if you think two answers are possible, tick the best option. Tick the best option. Anybody answer, please? Answer, come on. Think and answer. There is no charge for thinking. Thinking is a very rare job nowadays. The answer is very simple, fair value. The very beginning of the chapter states that financial assets and financial liabilities are measured at fair value. Is it right? For items that are not measured at FVTPL, transaction costs are also included in the initial measurement. So the answer was C. This first one is consideration paid or received. Now this cannot be the correct answer because sometimes we give loan to employees at a concessional rate. We compute fair value. Parent gives loan to subsidiary at concessional interest rate, but we compute fair value. Again, acquisition cost cannot be the answer in all cases. Okay, because if acquisition cost is much below or much above the fair value, then we have to record at fair value, and the difference is adjusted in either P&L account or some other item. And then consideration paid or received for financial asset or financial liability. This A and D are exactly same statement to confuse you. If A is wrong, D is also wrong. Tick mark option C. Question number 7, please solve yourself. Under Ind AS 109, all of the following are the characteristic of derivative, except 3 options are defining derivative, 1 is not. Choose the odd man out. Anybody? Odd man out. Question number 7. Question 7. The correct answer is A, because the definition does not talk about the purpose of generating a profit from short-term fluctuation. This is not the object or definition. Its value change in response to underlying. Yes, this is a correct part of the definition. It requires no investment or very low initial investment. This is also definition, and settled at a future date. So these 3 together, last 3 together will be characteristic of derivative, but this is not. Derivative can be used for hedging also. So tick mark A. Question number 8. Under Ind AS 109, is a derivative, for example, an equity conversion option that is embedded in another contract, for example, a convertible bond, accounted for separately from that other contract? Is derivative contract separated from other contract? That is the question. Do we separate embedded derivative? Don't say yes, you have to tick the correct option. Yes, no, that I don't want. I want you to answer A, B, C, D. The answer is D. If you have read your standard carefully, the answer says it depends, and that there is a condition. The condition is that the embedded derivative will be accounted separately if and only if economic characteristic and risk of the embedded derivative and host contracts are not closely related, and the combined contract is not measured at fair value, with change in fair value recognized in profit and loss account. So this is what our standard talks about embedded derivative. Your answer D was right. Okay, question number 9. Which of the following is not a condition for hedge accounting? Not a condition for hedge accounting. They can ask question from any corner. Formal designation and documentation of hedging relationship and the entity's risk management objective and strategy for undertaking the hedge at the inception of hedging relationship. So this is a part of the condition. The hedge is expected to be highly effective in achieving offsetting changes in fair value of cash flow attributable to hedge risk. The effectiveness of the hedge can be measured reliably, and the hedge is assessed on an ongoing basis and determined actually to have been effective. This is also a condition. For cash flow hedges, a forecast transaction must be highly probable and must present an exposure to variation in cash flow that could ultimately affect profit or loss. Okay. The hedge is expected to reduce entity's net exposure to the hedge risk, and the hedge is determined actually to have reduced the net entity wide exposure to hedge risk. This condition is not there. You can check. We have dictated or read these three conditions only. The answer is D, because the hedge is determined actually to have reduced. There is no actual proof required. It has to be highly effective. So tick mark D. That was a little difficult one. Question number 10. What is the accounting treatment of the hedging instrument and the hedged item under fair value hedge accounting? Under fair value hedge accounting, please reply. What is the accounting treatment of both the instrument, hedging instrument and hedged item, under fair value hedge accounting? Some of you are answering A, D, so the correct answer is A. Correct answer is A, although D was also quite close. The hedge instrument is measured at fair value, no doubt, and hedged item is measured at fair value with respect to the hedge risk. Change in fair value are recognized in P&L account. Hedged item goes to P&L account, hedge instrument goes to P&L account. When both are transferred to P&L account at the same time, the impact on profit and loss is very low or negligible or not there. This one, the hedging instrument is accounted for in accordance with the accounting requirement for the hedged item. This is wrong. The hedging instrument is accounted as per fair value only. That is, your point number 2 is wrong, because hedging instrument is always recorded under fair value hedge at fair value only. It is not measured at amortized cost. The question of a derivative measured at amortized cost is not possible. So option D is wrong. Any doubt? Any doubt? A was the best of the lot. Now next is last question. What is the accounting treatment of the hedging instrument and hedged item under cash flow hedge accounting? Very good question. Try yourself. Give me the answer. Yes, please read carefully. Read carefully, line by line, word by word. Anybody wants to reply? Look at this option. The hedging instrument is measured at fair value. With change in fair value recognized directly in equity, means cash flow hedge reserve, to the extent hedge is effective. To the extent hedge is effective, ineffective portion is transferred to P&L account. The accounting for the hedged item is not adjusted. Accounting for the hedged item is not adjusted. This is the right answer. Some of you said B also. So let me explain why B is not right. The hedged item and hedging instrument are both measured at fair value with respect to the hedge risk, and change in the fair value are recognized directly in equity. One student is saying change in hedged item we take at a fair value. Not necessary. It will depend on what is that hedged item. It will depend on what is that hedged item, and therefore hedged item is not necessarily measured at fair value. It will depend on what is that hedged item. Is it right? So the answer C is more appropriate. Answer C is more appropriate. Hedged item need not be always at fair value in cash flow hedge reserve. So that was the wonderful discussion. Welcome to Ind AS 110 MCQs. So I am going to ask you some MCQs and check how much have you prepared. Okay, very simple question. Number 1 on the screen. A manufacturing group has just acquired a controlling interest in a football club that is listed on a stock exchange. So in short, one company has acquired another company controlling its stake. Okay. Then the management of the manufacturing group wishes to exclude the football club from the consolidated financial statement on the ground that its activities are dissimilar. How should the football club be accounted for? Read the options and give me the answer. Let us see who will answer first and correct answer. The entity should consolidate as there is no exemption from consolidation on the ground of dissimilar activities. So this option seems to be right. So I will keep it on hold. The entity should not be consolidated using the purchase method but should be consolidated using equity method. Wrong. Entity should not be consolidated and should appear as an investment in the group entity. Wrong. The entity should not be consolidated. Details should be disclosed in the financial statement. Wrong. So the first option is right. Irrespective of the nature of activity, a subsidiary would be consolidated. Right? Unless they qualify for exemptions given in the standard, which is not mentioned in the problem, by default a subsidiary will be consolidated irrespective of its level of activity. Okay, try one more. Question number 2. Which of the following is not a valid condition? Not a valid condition that will exempt an entity from preparing consolidated financial statement. Which of the following is not a valid condition? First option is parent entity is a wholly owned subsidiary of another entity. The parent entity's debt or equity capital is not traded on the stock exchange. The ultimate parent entity produces consolidated financial statement available for public use that comply with Ind AS. The parent entity is in the process of filing its financial statement with SEBI. The parent entity is in the process of filing its financial statement with a SEBI. So tick mark D. It should not be in the process of filing the financial statement. Is it right?
Yes.
If you are in the process of listing, then you are not exempted. So the answer will be D. Answer, write down D. Please mark the answer as D. A, B, C, D. Okay. Then the third question is, what is the purpose of Ind AS consolidated financial statement? Option A is to provide guidance on the preparation and presentation of CFS.
Yes.
Option B, to provide guidance on preparation and presentation of individual financial statement. Option C, to provide guidance on preparation and presentation of subsidiary financial statement. From where do they get such idea? And to provide guidance on the preparation and presentation of parent company financial statement. Even this is wrong. It is a guidance on preparation and presentation of consolidated financial statement. Tick mark option A. Option A is the right answer. Now come to question number 4. Who is responsible for preparing consolidated financial statement? Subsidiary, parent, audit firm, regulatory authority. Parent company. Sure. B is right. Option B is right. Parent company is right. Very good. One more chance. One more chance. What is the primary objective of preparing consolidated financial statement? If they ask you in the interview, what is the purpose of preparing consolidated financial statement? What answer will you reply? To show the financial position and performance of the parent company only? No. To show the financial position and performance of each individual subsidiary? No. To show the financial position and performance of the group as a whole? Yes. To show the financial position and performance of the auditor? I wish there would have been some standard like that. Most of the auditor would have failed. Okay. Enjoy. And one more question. When should an entity apply the principles of Ind AS 110 for the preparation of consolidated financial statement? When will Ind AS 110 be applicable? Option A, when it controls one or more entities. Option B, when it has significant influence. Option C, when it has joint control. Option A, Ind AS 110 is applicable when there is a control relationship. For significant influence and joint control, we have two other standards, Ind AS 28, which is applicable for associate and joint venture, and Ind AS 111, which is applicable for joint operation and joint venture. So the correct answer would be A. Is this answer right now?
Yes.
Louder, yes.
Yes, sir.
Now we'll take MCQ on Ind AS 111. Are you ready for this?
Yes, sir.
Check how much you have studied Ind AS 111. Joint arrangement. Question number 1. What are the types of joint arrangement as per Ind AS 111? Option A, joint operation, joint venture. Option B, partnership and joint operation. Option C is joint venture and partnership. Option D, joint operation and consortium. Yes, please reply. Option A, joint operation and joint venture. You have studied so much that in your dream also you will remember now. As per Ind AS 111, what is the definition of a joint arrangement? These are the 4 options. Read yourself and suggest me the right answer. Read the options on the screen. Read the options on the screen. The answer is A, that establishes joint control of an economic activity. The definition nowhere talks about joint ownership or joint management or joint ownership and joint control. These 3 are wrong. The definition only speaks about joint control. The answer A, tick mark. Okay, try Ind AS. Try question 3 under Ind AS 111. What is the definition of joint control? Joint control definition. Please try. Read the question on the screen. Think yourself for a minute what can be the answer. If you have studied Ind AS 111. The answer is A. It only talks about contractually agreed sharing of control of an economic activity between two or more parties. It doesn't talk about ownership. It doesn't talk about management. And again, it doesn't talk about ownership. It only talks about sharing of control. The option A is the right answer. Try fourth question. What is the presentation of a joint operation in the financial statement of the parties involved in the arrangement? Read the option, think about the solution. Most of the students are saying A. Parties involved in joint operation should present their proportionate share in asset, liability, income, expense in SFS. So this is right. Why others are wrong? Let us see. Parties involved in joint operation should present the joint operation as a subsidiary. Oh my God. Should present as a jointly controlled entity. Wrong. Should present as an investment in associate. Wrong. So the answer was A. So dear friends, we are going to start MCQs on Ind AS 113. Are you ready to test your knowledge of Ind AS 113? Question number 1. What is the purpose of Ind AS 113 fair value measurement? So read those 4 options and tick mark. To provide a definition and a framework for measuring the fair value. To provide a definition and measuring the fair value framework for estimating the value of asset and liability. To provide a definition and framework for determining the value of intangible asset. Is it only applicable to intangible asset? This is gross mistake. To provide a definition and framework for determining the value of financial instrument. Is it only applicable to financial instrument? No, it's applicable to fair value of all assets and liabilities. So therefore, and here it is written estimating the value. They should have used the word fair value. So this is also not acceptable. So fair value of asset, liabilities and equity. So which is the right answer? A. You can follow elimination technique also. Try this one. What is the highest and the best use for the purpose of measuring fair value under Ind AS 113? You have used this term highest and best use for non-financial asset. So let us try the options. The highest and best use is the use of an asset that would maximize its value, right? Let us read others also. The highest and best use is the use of an asset that would minimize its value. This is wrong. Eliminate. The highest and best use is the use of an asset that would increase its value. Wrong. The highest and best use is the use of an asset that would change its value. Wrong. So what is the right answer? A is the right answer. Very good. Keep answering. Okay. Let us come to question number 3. What is the definition of fair value under Ind AS 113? So you will be getting very close options, and only if you know the correct definition you will get the answer. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant. Is it right? Seems to be right. Let us just hold it. The price that would be received to sell an asset or paid to transfer a liability in an immediate transaction. What is the correct word in the standard? Orderly. So this is wrong. The price that would be paid to sell an asset or paid to transfer a liability in an arm's length transaction. This is also wrong because the correct term used in the standard is orderly transaction. In your intermediate, this arm's length word was used. We are not intermediate student anymore. We have grown up. Now point number D, the price that would be received to sell an asset or paid to transfer any liability in a forced transaction between market. This can never be fair value. So again the answer is A. Question number 4. How should a company determine the fair value of an asset or liability under Ind AS 113? So the options are: companies should determine the fair value based on the market price of the asset or liability. Is it right? Then companies should determine the fair value on the basis of cost of the asset or liability. Companies should determine the fair value based on the net present value of the asset and liability. And companies should determine the fair value on the basis of replacement cost of the asset and liability. So the answer is A. This is actually the first preference. So if you have to really choose one of the 4 options, the first option, level 1 input, is market price, option A. Now next is one more question. What is the basis for measurement of fair value under Ind AS 113? Basis for measurement of fair value. It is based on market approach, based on cost approach, based on income approach, and based on asset approach. Market approach. From market participant point of view, we check the fair value. So again the answer is A. Sir, all answers are A only. 6 will also be A. Let us take mark. Don't do that. Okay. What is the meaning of a market participant for the purpose of measuring fair value under Ind AS 113? What is the meaning of market participant? Market participant is a person or entity that buys or sells assets or liabilities in the market. Market participant is a person who invests in the assets or liability. This is not right. They have never used the word invest. Market participant is a person or entity that lends money to other market participant. Oh, these are all imaginary definitions. Market participant is a person that provides financial advice to other market participant. If you have read the standard, you will find that, oh, this is such an easy option. But if you have not read the standard line by line in detail, you may make a mistake. The answer was A. Again, one more question I will take, then it is your good luck. What is the meaning of orderly transaction for the purpose of measuring fair value as per Ind AS 113? Orderly transaction means a transaction in which the buyer and seller have equal bargaining power. An orderly transaction is a transaction in which the buyer and seller have unequal bargaining power. No, it can't be orderly transaction. An orderly transaction is a transaction that takes place in a normal market condition. An orderly transaction is a transaction that takes place in exceptional market condition. Exceptional is also not right. So now there is a choice between A and C, 50-50. Orderly transaction means normal transaction. Okay. Nowhere the standard have used the term that they must have equal bargaining power. It should be normal transaction. The buyer knows the price, the seller knows the price, the buyer is free to buy or not to buy, the seller is free to buy or not to buy. There is no force, threat, coercion involved in the transaction. That is called orderly transaction. So the answer was C. Now we are going to take multiple choice question on Ind AS 115. Some important question I have identified for you. You can practice more MCQs. Okay. So let us take question number 1, MCQ on Ind AS 115, revenue from contract with customer. Read the question, think, and then give me the answer. I am sure you might get little confused But yes, if you have read the standard carefully, you will be able to get the right answer. So it is a challenge for you to get the answer right. Okay. So I will read the question for you. Which of the following fall within the scope of Ind AS 115? I am not going to give you any hint. Revenue from contract of insurance, revenue from operating lease, revenue from non-monetary transaction between entities engaged in the same line of business to facilitate sales, and the last is revenue from contract with variable consideration. So I would ask you to give me the answer of this MCQ. Think you are sitting in the exam and this question has come. What answer would you write? Anybody answer? Visualize the answer. Visualize the answer in your mind, and then I will disclose the correct answer. First, does not fall in the scope of this standard. This also does not fall in the scope of this standard. This also does not fall in the scope of this standard if there is non-monetary transaction between entity in same line of business to facilitate sale to the customer. Like two companies supplying bottles may supply to each other customer to facilitate sale. It is not covered by this standard because it is not treated as revenue. Then the only answer left is this one. Revenue from contract with variable consideration is covered by this standard. So if there is a variable consideration, it is estimated subject to certain conditions given in the standard and it will be recognized. So let us search for that answer which says option D is right. This answer. This says only 0.4 comes in the scope of Ind AS. So tick mark C. C was the right answer. Okay, we'll try one more. Question number 2. If the entity expects to recover, what are incremental cost? What are incremental cost recognized as an asset? What are incremental cost in Ind AS 115 recognized as an asset? So option A, if the entity expects to recover those costs from the customer. Option B, if the entity does not expect to recover those costs from the customer. Option C, if the entity expects to incur such cost over a longer period of time. And option D, if the entity wants to defer such non-recurring expense. For question number 2, spot the correct option, correct answer. Spot the correct option. When are incremental costs recognized as an asset? So you have given the correct answer. One student has replied option A is the correct answer. If the entity expects to recover those costs from the customer, then incremental cost will be recognized as an asset. We have taken few questions on that in our class. Question number 3 now. Which of the following indicate that entity is not a principal? Entity is not a principal as per Ind AS 115. Which of the following indicate that entity is not a principal? Entity does not have inventory risk. It has discretion in establishing the selling price. Consideration received is in the form of commission. Exposed to credit risk for amount receivable from a customer. So which of these indicate entity is not a principal? So identify condition required for being an agent. Anybody? One student is saying option B. An entity does not have inventory risk is correct. This is a sign of an agent. It has discretion in establishing selling price. This is a wrong option. Consideration is in the form of commission is a right option. Exposed to credit risk. Agent is not exposed to credit risk. So you have to search for that option which has 1 and 3. These are the tricky question, okay? And therefore the answer is B. Now we'll come to Ind AS 116 MCQs. All the students should focus on MCQ. It will test your knowledge on how much you have understood Ind AS 116. So are you ready? Are you ready for this amazing test? Yes. So let us solve MCQs on Ind AS 116. Question number 1. What is the effective date for Ind AS 116? Effective date for Ind AS 116. Come on, reply. Effective date for Ind AS 116. Anybody who knows the answer? Option A. One student is saying option A. Very good. Ind AS 116 has become effective from 1st January 2019. Second question. Now you have to test your skills. What is the main objective of Ind AS 116? Main objective of Ind AS 116. Option A. To increase the transparency and comparability of lease transaction. Second is to decrease the amount of lease liability on the reported on the balance sheet. To eliminate leases from financial statement. Amazing. And to increase the recognition of revenue from leases. What is your answer? Again the answer is A. Other answers are far away from the correct answer. So the answer for writing objective of leases accounting is increased transparency and comparability of lease transaction. Please tick mark option A. Third question. Which of the following is not a type of lease? Not a type of lease. According to Ind AS 116, there are 4 options. A. Operating lease, financial lease, sales type lease and service lease. Service lease. This you can just make a small correction. Sale and lease back. Sale and lease back. Third one, make it sale and lease back. And the fourth one is service lease. Do we have anything called service lease in this standard? No. This is not covered under Ind AS 116. Tick mark option D. Question number 4. When must a lessee recognize a right of use asset and a lease liability on its balance sheet? Option A, at the commencement. Option B, at the end of lease term. Amazing. Who can give such options? When the lessee exercises a purchase option. And fourth, when the lessor delivers the underlying asset. When would you recognize the right of use asset and the lease liability? Option A. Most of the students are saying option A. Yes, the answer is option A, at the commencement of the lease. Next, point number 5, question 5. What is the discount rate to calculate the present value of the lease payment under Ind AS 116? Lessee's incremental borrowing rate, lessor's interest rate, prevailing market interest rate, lessee's weighted average cost of capital. Good question. What is the answer? The answer is option A, incremental borrowing rate. This answer is not right. It would have, if it was written interest rate implicit in the lease, then this would have been right. But they have written lessor's interest rate. Lessor's interest rate is not the interest rate implicit in the lease. So this is wrong. These other are also wrong. Option A is right. Now we'll come to question number 6. What is the effect of the lease modification? Very good question. On a lessee's lease liability and ROU asset under Ind AS 116. We have studied lease modification. Option A. Lease liability and ROU are derecognized and re-recognized at the modified amount. Option B. Lease liability and ROU assets are adjusted to reflect the modified amount. Option C, lease liability and ROU asset remain unchanged. Amazing. Who can give such options? The lease liability and ROU assets are reclassified as a different type of lease. So most of the students have said B. B is the right answer. We are going to adjust the carrying amount of ROU asset and lease liability. How to do this calculation we have explained in the chapter in detail. Now we'll go to question number 7. One more practice. What is the recognition of variable lease payment? Variable lease payment under Ind AS 116. Option A, expense in P&L account. Option B, reduction in the ROU asset. Option C, reduction in the lease liability. Option D, reduction in the lease payment. These three options given are not possible only. So the only possible answer is expense in the profit and loss account. You can just mention if not related to index, if not linked to index, because if it is linked to index, then I will have to adjust in ROU asset and lease liability. So we are talking about contingent rent here, rent which varies with sales or output or number of hours or usage. In that case, it is not difficult to determine the lease payment at the commencement. Hence, they are contingent. They are charged to P&L account as and when incurred. So this is about the treatment of contingent rent in Ind AS 116. So thank you very much for joining me for this MCQ session. I would request you to subscribe to the YouTube channel today only. Okay, and also inform your friends. We are going to upload more MCQs on the YouTube channel AS Foundation. Thank you very much.
Are you feeling overstressed by your CA syllabus? Get the best CA revision lectures by top CA leaders, specially designed to boost your confidence and knowledge. And the best part of the lecture is that they are available at super affordable prices and available at any time, anywhere. So hurry up and place your order from our website vinod.in. It is a perfect solution for your last minute revision.